Privilege to introduce the speaker. Punarvas Jayakumar, qualified in 2012, has extensive experience in corporate laws, taxation, insolvency and bankruptcy code, and RERA. He has worked with major clients such as Infosys, MetLife, and ING, and has co-founded ThinkFin Solutions LLP, a consulting firm specializing in ITGC, SOC, forensic audit, valuation, and certification, risk advisory, investment and wealth management, core business advisory, global mobility services. A member of the Board of Studies at CA Punarvas University, Bangalore, he has authored books on corporate laws and taxation. With the advent of technology, he has taught over 1 lakh CA students as a regular guest speaker at ICEA seminars across South India. He has also contributed as a faculty across multiple ICA branches. Beyond his professional achievements, he is a nature enthusiast, wildlife photographer, and a co-author of a coffee table book titled Life in the Jungle. With this brief introduction, I introduce the speaker and open the floor for his discussion.
Thank you, sir. Hi, good afternoon. Good afternoon, all of you. I can't hear you. Good afternoon. I know it's a very challenging session because it's post-lunch, so we'll try to keep it as interactive as possible. And unfortunately or fortunately, it's a very hot topic now, loans to directors. So we will try to make it as interactive as possible. So thank you so much for coming here. And first of all, thanks to CA Pramod and the managing committee of Bangalore branch. Bangalore branch is very, very close to my heart because when I cleared CA in 2012, and I still remember there used to be a lady called Rama madam. So I sent a mail to her saying that I really am extremely passionate about teaching. Please give me just one opportunity. So when all the doors were closed, Rama madam and with the then chairman gave me an opportunity to handle classes at CA, all the 3 levels of CA, to which I am eternally grateful. That's the reason why, which fueled my passion to be a trainer. Oh, nice. So that is what it is. Just give us 1 minute, so we'll just start off with the discussion. Sir, switch on. Okay, so so it's a very, very interesting discussion today in the light of recent events, including this event. So let us wait for. So yeah, post-lunch session. Yes, even the electricity. Sir, switch it on, please. Okay. So this is an area which was ignored all these years by all of us, unfortunately or fortunately. It is more unfortunate because now with the advent of an institution which we all sort of are scared about, National Financial Reporting Authority, it has come to the fore that we really have to study this particular topic in the way it has to be studied. So this discussion we will be spreading across 2 sessions, and we'll try to cover in as much depth as possible. So let's keep it very, very interactive. You can stop me wherever you want and we can discuss. And I'm here to learn as well. Just because I'm on the dais doesn't mean I'm here to share the knowledge. I'm also very much willing to know from your practical expertise as well. So there are many stalwarts sitting here also. I would definitely want to learn from you. So whenever you feel that there is a need to just stop and we'll have an interactive, let's keep it interactive is what I say, because it is post-lunch session, it's going to be challenging. But I can assure you we'll make it as interactive as possible. So without further ado, I just want to show you a picture, a screenshot of where things begin. So this is the National Financial Reporting Authority with our Honorable Prime Minister there in all the websites anyway. But yeah, this is of course the NFRA website, where if we go to the orders page, right? So sometimes we as CAs we'll read it as Sabka Saath, Sabka Vikas, CA Ka Vinash. That is what we read it as. But then we realize no, it's Sabka, Vishwas, so to speak. So let's see, do we really have the Vishwas here or not? The first order, unfortunately, my dear friends, was as recent as 19th August. And I'm not sure how many of you had a chance to go through this. But if you have gone through this in depth, we will shockingly see serious lapses in section 185 and 186. So that is what we really want to see today, what should not be done. Unfortunately, it has become a post-mortem now. We have to see and just learn from the past. As they say, history are not events of the past, it is guidance for the future. So at least we can go through this and just figure out what lies ahead for us. So that is what it is. So you can see so many orders there, unfortunately, and you see this very sad headlines in various newspapers. NFRA slaps, especially the words that they use, slaps rupees 10 crore penalty on BSR and Associate in the copy day case, debars to auditors. Then NFRA order 10 years debarment and heavy monetary penalty imposed on CA due to lack of professional skepticism. So NFRA takes action, second time statutory auditor debarred from practice for 3 years. So if you see, these things have become commonplace now. And if we sort of sit back and look at ourselves, in retrospect, if we do some introspection, though NFRA is harsh in their wordings, somewhere we feel that we are also lacking in our understanding of these sections. So it is time for introspection and not just blame game. That's the reason why we are here today. And it's always nice if we see the penalty first and then work back towards what we are supposed to do. It I feel is a very motivating factor for us. When I was doing CA, I always used to put a marks card, a fake marks card which said FAIL. So seeing that only I used to get motivated, and then that's how I passed the examination. Thankfully now CA Institute has changed that and they have made it successful and unsuccessful. So it's really, really good, because fail is such a word with a negative connotation. So coming back to this punishment for contravention. So if you, I am sure all of us can see, and do not worry about this, I'll be sharing this presentation with all of you. So you don't have to make any notes as such, but let's try to participate. So section 139 to 146 are the sections with respect to chapter 10, that is Auditors of Companies Act. If we violate any of those provisions, as you can see here, the penalty is 25,000 to 5 lakh rupees, and officers in default. Any officer in default, that is for the company. Company has to pay so much. Officer in default will have to pay 10,000 to 1 lakh. Now this is okay, this is for the company, so we may not care about it. But if I have to see the penal provisions for the auditor, interestingly, if we do not follow section 139, that is appointment of the auditor, 144, all the services that the auditor should not be providing when he is auditor of a company, and section 145 with respect to signing of the audit report, inadvertence, even by mistake, if we, commit an error, then inadvertence, minimum 25,000 and maximum 4 times the remuneration. And it can go up to 5 lakh also, whichever is less. But unfortunately, if it is willful, so we have 8 times remuneration, and this is one deadly point. The law uses the word and. It is not or, law uses the word and that is one line which shakes up every chartered accountant. It says and imprisonment up to 1 year. For those of us who have done CA, we are already imprisoned for 4 years while doing the course. And for us to come out and do something and again, being imprisoned is something that we really do not wish to do. So, and of course, apart from that, we have to refund all the remuneration that we are promised to receive from clients, which they'll never pay. So, if at all, whenever we receive it, we need to pay that back. And apart from that, damages, civil liability, criminal liability, it goes on to say, and then 132 comes, our NFRA, and removes everything away. 132 says, notwithstanding anything contained in the law, it's a non-obstant clause. It overrides all of these sections. And it says, we will impose penalty. We will, this can be in addition, they say, but we will also impose our own penalty, and that is the reason why, unfortunately, we are saying so many things. So, today's discussion, after having seen the penal provisions, which would obviously probably wake us up from the slumber, literally and figuratively. So, we need to now have an in-depth analysis of the sections 185, 186 and 188. To be honest, 3 hours is not enough to do justice to these sections. It requires a full day seminar. Probably we will do that some other day. But whatever possible, we will definitely do. Rather than doing something and everything, I would want to cover exhaustively these provisions. And of course the penal provisions, and most importantly, as and when we do the provisions, we'll also look into the auditor's duties. What should an auditor do? Because that's the seminar all about, the statutory, from the lens of a statutory auditor. So that is what we are here, assembled here to do. So moving on to the first discussion item, that is section 185, loans to directors. So before we get into this section 185, we also need to look into two small sections which are there in the Companies Act, 166.4 and 166.5, which speak about two very interesting things. It says, as a director, as a, auditor, there should never, or as a director, let's take directors first, there should never be any conflict of interest. A director should never have any conflict of interest in the company. But then that is, just a very idealistic scenario. So lawmaker also knows that. So he inserts one more subsection, And he says, in case there is any conflict of interest, no problem, there should not be any undue gain. So you cannot have any undue gain in the particular company, directly or indirectly. You have a contract with one more company in which you are a director, no problem, but do not make any gain which is not due, which is obviously seems to be very, what do you say, disproportionate, so to speak. So to counter this, we have 4 sections. One is section 184, that is called disclosure of the director's interest. So if you are interested in any contract, whether financially or otherwise, you need to disclose in the meeting. In the first meeting of every financial year, you need to disclose saying that these are the companies in which I am the shareholder, these are the companies in which I am a director, these are the partnership firms in which I am a partner. Everything has to be disclosed here. This is under section 184. So we have 4 protection mechanisms in the Companies Act. One is 184, disclosure of director's interest. The other one is what we are discussing today. So we are coming back from the source. The source of this entire 185 actually stems from 2 seemingly innocuous sections, 166.4 and 166.5. So 185 says loans to directors. As a director, can you take loan from a company? That was the biggest question which was there from 1956 and before 1956 itself. Then we have intercorporate loans and advances. So how is the interplay between these two in the context of statutory audit is what we are discussing. And of course there is no time, otherwise we could have done one more thing, that is the related party transactions. And these 4 sections have to be done in unison together. Only then we will understand the full measure of this section and the gravity of the situation. And it is accentuated by what we have recently, just few days ago on 19th August, whereby almost out of the 30-page report of NFRA, 20 pages speak about only these 4 sections, which is shocking. So I will definitely give you a gist of the case that happened, because we should know now what not to do in the future. Again, history is guidance for the future. So basically, as of now, as far as the disclosure is concerned, we have one disclosure in the board report under 134 3G and 3H, where the board has to disclose during this year, this is the loan that I have given, this is the intercorporate loans I have made, these are the related party transactions that the board will do. And of course, the board also has to look into the disclosure in the financial statements. Now, as far as auditor is concerned, he has to look into many other aspects, most importantly, CARO. In CARO, we have clause number 3, clause number 4 and clause number 13. These 3 clauses specifically say that you should look into in-depth 185, 186, 188 and 184 and report accordingly. So most of us, I did my articleship during 2008 to 2011. That time, these sections were not of any importance. Actually, even till as recent as 2 years ago, it was not important. So how we did our CARO report, we all know. All of us have done articleship. So we used to go to our boss used to see the entire report and like, hey, where is CARO? So 2 minutes I'll come. Right? It's like Maggie noodles. Go there, find a old form, Control F, change the name of the company and give a CARO report, clean report. All of us have done it, we know, I can see the smiles. Right? So the thing is, that was another completely different era. Now we cannot afford to train our article students like this because things have changed. Because if we train them wrong, we'll end up in the eyes of NFRA or anybody for that matter. Even in our professional misconduct as well under the CA. So auditor's report is what we will be concentrating today. Clause number 3, 4 and 13. But before we go into the reporting aspects, we should understand whether we really truly understand the law in its clear sense. So that is what we are doing today. Anyway, punishment I have already spoken about. So a bit of history of section 185. Public money in a public limited company, public will pump in money in a public limited company, no doubt about it, and I will pump it into business, fair enough. That's how all companies work. Now, rather than that, can I give it as a loan to a director was the fundamental question many years ago. So if I take money from the public, rather than investing it in business, can I invest it in the directors was the fundamental question. In fact, section 86D of the Indian Companies Act 1913 actually allowed this. It goes without saying because anyway Britishers looted us in all possible ways directly. So there is one more way of looting indirectly, because you can take money from the public and then instead of pumping it to the business, you can give it to a director. There ends the matter. But of course, when the 1956 law came, so 1956 law said no, it is not possible it is possible only with the permission of the central government. So in 1956, there was a tectonic shift, so to speak, in the way the Companies Act was perceived, and there they said, no, you cannot give loan to any director, but you can give. Generally you cannot give, but if you want to give, you should take the approval of the central government. So from 1956, all of us studied the 1956 law, till 2013, this was about it. But they said you cannot take permission. I mean, you have to take the permission of the CG, you cannot give it directly. That is what the law said. But interestingly, whenever the law is there, there are also people who find loopholes in the law. And what they did was, rather than taking loan directly, always they used to take loans through the relatives of the director. What used to happen. So this, because here they said, you cannot give loan to directors directly without CG permission. But can I give it indirectly like this? It was possible. So in 1960, again an Amendment Act was passed where they said indirect loans also not possible. So from 1960 to 2013, could you have given loans to directors? Generally no, but if you wish to give, whether it is directly or indirectly, you have to take the permission of the central government. This was a established position for so long. However, in 2013, because till 2013 people were finding other ways of giving loan. Rather than investing it in business and rather than giving goods on credit to others, they started selling, as per the report which I was reading, they started selling goods on credit to the directors. And directors used to use that money and sell the goods, basically take the money and give it to the company as per the normal credit policy. So can any director take the goods on credit and in the disguising the entire loan as a sale of goods on credit, could they have done, was the pertinent question in 2013. This also was plugged in the section 185. So in 185, there was a lot of changes that came in the year 2013, and the entire section 185 was again replaced in the year 2017, if you remember, where the entire section only was replaced, so not just a few subsections. The whole section was replaced with one more brand new section, which had the amendment. So in that regard, now before we start anything, I just want to have a sense of the an idea here as to what is covered in 185, what is not covered. So just to make it a little interactive, I have just made a quick quiz sort of a thing. So it will be nice if you could just scan this code, or you can just go to open your mobiles. It's just a fun way of doing it. It's an anonymous quiz. It's just to understand, as of today, whatever we know, we don't know, it's okay, no problem, we are all here to learn. But if you can just open your mobiles, you can either scan this code. If it's not possible, you can just type in vvox.app on your search window and just type in this ID 175847878, and then you can write this answer. What is the gist of section 185 according to you now? Whether we know or we don't know, it's absolutely fine. We are all here to learn. All of us will be practicing in some area or the other. That's why we are here to learn about this intricacies of the company law. So this will give us a chance to understand where we stand as of now. And at the end of the session, what is the key takeaway that we have? So it will give us a good assessment, metric. So if you could just, all of us here, whoever is interested, it will be nice if everyone participates. Anyway, anonymous. Nobody will know what we have typed, but it's just for like a self-assessment. So what is the gist of section 185? Is it that all loans covered under 185 are prohibited? Is it like that? Or most loans are prohibited, some are allowed with restrictions according to you? Or most loans are actually allowed with restrictions and some are prohibited? Is it like that? Or most loans are prohibited, some loans are allowed with restrictions, whereas others are allowed subject to other sections? So should I read 3-4 sections to understand that, or what is the, according to us as of today, without even starting the section, what is the gist of section 185? So I can see 27-30 people who have already taken up, but you can choose the answer. Nobody will know the answer what you have typed. It's not any competition here, fastest finger first, it's not that. It's just a way to assess where we stand now, and 2 hours later where we'll stand. So that is the idea, nothing else. I'll just give a few more seconds and then I will end this particular quiz. just to get a sense of what people have answered and what they have not answered, just a few more seconds, 10 more seconds. There are 8 more people who are yet to do it, so I wait for them. Fine, so I'll just end it now. Let's see. Okay, very good. So 5% of you have told that all loans covered under 185 are prohibited. 25% have told most loans are prohibited, some are allowed with restrictions. 20% have told most loans are allowed, but whopping 50% of you have given the answer that most loans are prohibited, some are allowed with restrictions, some are subject to other sections, and you're 100% right. The 50% in this room have got it right. Very good. So others, no problem. It's not a competition, as I said. We are all here to learn. So let's learn exactly what it is. So the gist of the section is, are loans prohibited or not? We will see. So with this in mind, let us now dive into the area. So the breakup of section 185, just to give you a gist of the story. 185 covers both private companies and public companies. When I say 185, when I say company, company is the giver or receiver? Giver of loan or receiver of loan? Giver, obviously. We are here to talk about company giving loans, right? And what all is covered? We have 3 things which are covered: loan, guarantee, and security. So these are the keywords that we need to see in an audit, whether it's a loan, whether it's a guarantee, whether it's a security. So first of all, just breaking down the section. Private company, public company, both are covered. 3 elements are covered: loans, guarantee, and security. And to whom is the biggest question that we have? First we say directors, and the second concept is somebody called as interested party. Now we need to understand who is this interested party, right? So in interested party, strangely, this was the amended section in 2017. So 185.1 gives the list of people who are prohibited from taking a loan from the company. 185.1. 185.2 is the list where you can give a loan, but it is with certain restrictions. You need to take special resolution, etc., which was not done in the coffee day case. You will analyze that case. So first is, you are not supposed to give only. You are not supposed to give, loan to certain people. Second one, okay, to other people I'll allow you to give, but with restrictions. And 185.3 gives the list of those people where you can give the loans freely, no questions asked. Means section 185 will not come into the picture at all for those sections. So we need to dissect today in today's session who are the people coming under 185.1 to which I should report accordingly if the company has given loan. Who are the people under 185.2, and if at all company has given loan to people in 185.2, has the company taken the requisite permissions? The permissions would be board resolution, special resolution, and it should be used for the principal business activities of the company, all that we'll see. And third one is, who are the people where section 185 will not come? If that is so, which other sections would come? Would it require compliance of other sections is what we need to see in this entire thing. So of course, we know what is a private company, we know what is public company. There is some exemption for private company also, which means certain type of private companies can give loans. What are those companies? We'll see shortly. But our discussion, because reporting requirement depends on where this our interpretation lies in. So we'll have to see loan, guarantee, security, and there's one more interesting thing called book debt. Book debt I already told you, whereby they were disguising the entire loan as book debts, and then the director was a creditor here, he was selling it and then giving it back later. All those things used to happen. So now also they have clearly mentioned one line: loan represented by book debt. Normal book debt's okay, but if the auditor feels that it is a loan which is disguised as a book debt, then only he has to report. For that, obviously he has to use professional skepticism. So during the course of the session, I will be also integrating the guidance note on Karo and other things as well, so that it will be a combined session. We'll get the full value out of it. Now for the lot, one simple question which we should answer is, what is a loan? So that is a fundamental question. What is a loan? And strangely, nowhere has it been defined what a loan is. Right? So this issue went to Supreme Court as well. Strangely, this issue went to Supreme Court. So that brings to my second question, which you can answer. What is a loan? I'll use some pictures for entertainment. You know why? Yes. So of course you can just answer this question. What according to you is a loan? So Sri Vijay Mallya actually gave a new dimension to the word loan. He just said, leave me alone, and he left, right? So yes. So if you see, what is a loan? And this, mind you, this is a very primary question, but a very interesting question, because this issue went to Supreme Court. Nobody knew the definition of loan. So is it like I'm lending in cash or kind and receiving in kind? Let's say I lend you money, and in return I will take your Honda Activa. Is it a loan? Second, lending in kind, receiving in cash. I will lend you my Honda Activa for 5-6 months. 6 months later, you will pay me money. Is that a loan? Third one, I will lend you money. I will take money back, whether it is with interest or not, that besides the point. Fourth one is what? I will lend in cash or kind. Which means I can lend money, or I can even lend you my Activa. But 5 months later, 6 months later, whatever I recover should be in cash. Same issue went to Supreme Court. And that Supreme Court decision is very, very important for us to understand what is a loan. So if you could just, whatever, according to you what loan is, then we will see what the Supreme Court said of what loan is. Because loan has not been defined anywhere. In the Companies Act, Income Tax Act, nowhere. We just know the word loan. But what is a loan? So this was one of the cases which went to the court. I'll give you the citation later. So yes. So in that regard, what do you mean by loan? So all of you have answered. So let us see how we have fared. Just an exercise to keep it a little more interactive. So of course, first and second nobody has rightfully answered. But yes, third and fourth, lend in cash, receive in cash or kind is what some of you have told. That is around 40%. Whereas 60% of you have told you will lend in cash or kind, but receipt should only be in cash. So again, we have the majority who has given the correct answer. So as per the Supreme Court decision, you should always, loan is something where you will be lending in cash or kind. But the final receipt, if the company is receiving it back, it always should be in cash. Because the third one, if I am lending in cash but receiving a vehicle or something later, that is actually recovery of loan. It is not exactly repayment of loan. There is a difference between recovery of loan and repayment. So loan actually is only this. This is as per the Supreme Court. So first element that we need to check during our audit is has the company actually given a loan? So if yes, all the elements should be there. The Supreme Court has told that there should be a lender, there should be a borrower, there should be a valid written agreement with or without interest terms. That I don't care, but there has to be a valid agreement, and the giver can give in cash or kind, but the receipt should always be in cash. This is what the Supreme Court of India has defined what a loan is. If these elements don't come here, then it may be treated as an advance or some other element, but it is not a loan. Because the Bayer Act uses the word anybody who has advanced a loan. They have never told has given an advance. There's a lot of difference. So it says advanced a loan. Advance is used as a verb here, not as a noun. But the loan is used as a noun. So every word matters. So first element we have to discuss in our statutory audit is tell me what are the transactions during the year where the company has lent in cash or kind and has received in cash. That is what we need to take a note of. So you are 100% right about it. So this is what it is. So first matter is what is a loan? Fine. Private company we know, public company we know, exemption we'll see later. What is a loan? Definitely we have rightly answered now. Now what is the difference between guarantee and security? Guarantee and security. So guarantee is not secured by any mortgage of asset, whereas security of course has a mortgage of asset, as simple as that. That's the only primary difference between guarantee and security. Here I don't have to give anything, my name itself is enough, whereas in security I need to mortgage my asset. So that is the only primary technical difference as far as law is concerned between guarantee and security. So first element in our statutory audit is, am I auditing a private or public company, because the procedures will change. Second one, how many transactions are loan transactions this year, how many transactions are guarantee, how many are security, and do I see anything where loan has been disguised as a book debt. But the most important thing, which unfortunately the NFRA has pointed out that the CCD auditors have been extremely blind about, is the third one. Because they have identified this, they have identified this, but they have failed to identify that. Even if they had failed to do so, they failed to report accordingly. So we will dissect that also, no problem. So first is the directors. So as we know, directors, we don't have to delve deep into the definition of directors, but I am more interested about the interested party, 185.1, 185.2 and 185.3. So we will see that who are the parties who are covered here. But before that, there are three interesting things that I wish to state here. 185 in that subsection 1 gives a complete prohibition of the loan. There is one more section which again is today's discussion, 186. Under 186, three things are covered: loan, guarantee and security. This is allowed to a person actually. In 186, you can give a loan, guarantee or security to a person. However, you require a board meeting resolution and a special resolution under section 186. Special resolution to cross certain limits, but in all cases you would require a board meeting resolution. So it's interesting to note that 185 prohibits us from giving loans, but 186 allows me to give loans. So if I want to harmonize, is it possible? And to add to the confusion, there is one more section, 179.3, which says anybody can give loan to anybody. Company can give loan to anybody, no problem. However, it requires a board meeting resolution, and strangely, it can be delegated to the MD also. Like the company can tell the MD, boss, if you want to give loan in the course of business to anybody, go ahead. 1, 2, 3, 4, 5, you can give loan. So now creates a confusion in our mind what to follow. So if I try to harmonize all the three sections, I won't be able to harmonize, but definitely I can harmonize 185 and 186 because 185 is a specific section. The specific sections covering only what? Directors. Whereas 186 gives a more generic term saying person. So obviously of the lot, harmonious construction, would it be possible or not? Between 185 and 186, it is possible because as per the rules of interpretation, the specific section will override the general section. Specific section is very clear, loans to directors. So in our audit, what we need to check first and foremost is, we have seen private company, public company, loan, guarantee, security, all that is okay. But I need to see who are the people the company is giving loan to. Are they covered under 185.1? The first test would be, are they covered under 185.1? If it is a no, then I should go to the next section. Are they covered under 185.2? Because loan given to 185.1 people are completely prohibited. So there the reporting will take a different turn. Now if this is a no, then I should go to the next one, 185.2. There I will see, are the loans given to these people covered or not? I'll have to check that. Now if that is also a no, then I'll have to go to 185.3 because in 185.3, the people who are covered under 185.3, for them the entire section only will not apply. 185.3 starts with the line, nothing in this section shall apply. It doesn't say notwithstanding, it says nothing in this section, which means absolutely nothing will apply. Which means 185.3 is as good as saying 185 will not apply to me. But I asked you a question that time. If 185.3 says it will not apply to me, will some other section apply to them? And that is the beauty of 186. So when they offered me this opportunity to talk about it, I told Lata madam that I will handle both the topics because 185 and 186 are interlinked. So they said, should I do 186 first or 185? I said, just write both the topics and they say continued after the tea break. That's the actual logic of why I showed that because it's all linked. 185.1 is prohibited. 185.2 restricted, then I should go to 185.3. All the people covered under 185.3 and those people who are not at all covered here at all will all come under 186. If that be the case, why do I need that last section, 179.3f? There are certain cases where 186 also will not apply. That is given by 186 subsection 11 very clearly, where it says nothing contained in this section shall apply to 186, which means for those companies, for example, insurance companies, banking companies, those companies, your investment companies, section 186 will not apply. So can a banking company give loans to any people without following 186? Of course they can. But can they give loan to a director? No, because 185 is a prohibitory section. So if this is a sequence that we should follow in the exam, in the audit, wherever it is. 185.1, is the company giving the loan to 185.1? No. Then is it 185.2? No. 185.3? Irrespective, automatically it will go to 186. In a very rare scenario where loans have not been given under 186, only then a residuary section will come, 179.3. Because the moment it falls under this, the reporting requirement is different. For here, reporting requirement is different, compliance and reporting is different. For this, compliance and reporting is different, and for the last one, compliance and reporting is different. Everything is given in few lines in CARO, clause number 3, 4 and 13, which we have been ignoring unfortunately, which cannot happen from now. So yes, this is the entire scheme of things. This is what we need to look at. So moving on now, how the sections are done. So we also, now we need to cover exactly why we are here for. Who are the people under 185.1? Who are the people under 185.2? Who are the people under 185.3? Then if that be the case, what is the procedure in each of these things? Once we understand the law in all these areas properly, then we directly go into the CARO requirements. What are the reporting requirements that we need to follow? So moving on, friends, so first and foremost, let us discuss this. Right. So 185.1 covers these 4 people. I will discuss it through various illustrations. It says expression to any other person in whom the director is interested. It says director of the lending company, holding company, relative of any such director, partner of any such director, any firm in which such director or relative is a partner. So you will see all these things in the NFRA report when she checked that, because it had been given to all these people unfortunately. So let us see one by one. This loan we have already discussed. Now, if I take an example as Y as my lending company, if I take an example of Y as a lending company, right, and there are these directors. Just a second. One second. Yeah. So you can check the next question, which is on the thing. Right. So I'll explain it here, the question, and then you can write the answer, whatever you feel is the answer. In my example, Y is the lending company. Y is the lending company. This is the company in which you are doing the audit. That company has a holding company X. It has a subsidiary company Z. Very simple. The company which you are auditing, Y, lending company, has 5 directors. The holding company has 10 directors. All are different directors, mind you. And the subsidiary company Z has 2 directors. And interestingly, the company Y, this is what actually happened in Copy Day case. The company Y has given loan to all companies. It has given loan to 10 directors of X Limited. It has given loan to 5 directors of Y Limited. It has given loan to 2 directors of Z Limited. It has given loan to these directors. The question here is, in 185.1, loan given by Y Limited to how many directors are prohibited? Right? So is it 5? Is it 17? Is it 15? Or is it 7? So I hope the question is clear. Loan given by Y Limited to how many directors is prohibited? Is it only 5? Is it only 2? Is it only 10? Or is it 10 plus 5, 15? 10 plus 5 plus 2, 17? Or is it 5 plus 2, 7? All the options are covered. So that is the first question. We need to obtain a list of directors of lending company, directors of holding company, directors of subsidiary company, and then check whether the loan has been given to how many directors is what we need to see. So kindly answer according to whatever you feel is the answer. So all options are there: 5, 17, 15, 7. And mind you, this is a prohibitory section, which means if we do not get this number right, we are not reading the section properly. So that's the reason why I am telling. According to you, what would be the answer? 15 of you have written. I'll just give you 10, 15 seconds more. As you answer, I'll just open the Bear Act as well, so that we can analyze directly from the Bear Act. After this, I'll open it. Okay. So, most of you have answered. Right, let's see. Okay. So, the whopping majority of 57.14% have told loans to all the 17 directors prohibited. Whereas some of you are saying only 20% of you are saying that loans to only those 5 directors are prohibited, and 15 is told by 14%. Let's see what the answer is. The answer is option 3, 15, which means loan given by Y Limited to only, I'll just come back here, just a second. I'll show you the Bare Act, so that once we read the Bare Act, it will be very easy to understand. So let me open. So we'll have to go to section 185, and it's better to read the Bare Act and then understand this, because the CARO also very clearly, the first dialogue in CARO is a CARO guidance notice. The chartered accountant has to keep himself abreast of the sections 185, 186 before reading this guidance note. So that's the reason why we'll first read this, no problem. So it says, if you see here, no company shall directly or indirectly advance any loan. As I told you, advance is used as a verb here. Advance any loan. It doesn't say give any loan or advance. That's the difference, right? And here, any director of a company or of a company which is the holding company. That's it. It doesn't talk about director of the lending company. So if you see here in this entire structure, if Y is giving loan guarantee security to directors of the lending company, then this section is not applicable. It is only applicable to Y giving loan to directors of 10 directors of holding and 5 directors of the lending company. It does not matter if the loan has been given to 2 directors of the subsidiary company. 2 directors of the subsidiary company. The reason is very simple, because holding company directors can have control over the subsidiary company, whereas subsidiary company directors cannot have control over the holding company. I told you in the beginning, all the 3 are different directors. So all the 3 sets are different directors. So these 2 directors cannot have control over Y Limited, and they can't force them to give a loan. Whereas those 10 directors can force a subsidiary to give a loan. That's why lawmakers have only retained these 2. Now my question to you is, if we find during our audit where Y Limited has lent money to 2 directors of the subsidiary company,
yes.
which section will come here? Which section?
179.
179 or 186?
Sir,
Because in 186 it is special resolution. In 179 it is just board resolution. And if the company has not done anything, we have to report accordingly. If it is violation of 186, we have to report under clause 3 and 4. If it is violation of 179, then it's a simple emphasis of matter would suffice. That is the reason why I am asking, where will it come? Will it come under 186 or 179? So again we'll have to see this. If you see this, is it a director of the lending or holding company? No. So if I read 186, again it's an interesting area. If you read section 186,
sure.
if you read section 186, it is very clear in this particular area. It says here 186.2, no company shall directly or indirectly give any loan to any person. And who is this person? A person who is not covered under 185. So as we know, this here, this person, 2 people are not covered under 185. So in case we find during our audit that the lending company has given loan to 2 directors of the subsidiary company, 2 directors of the subsidiary company, we need to report under, or rather check the compliance and report under section 186 and not 179. And accordingly, all the reporting requirements will change. Whereas if at all I come to know that we have given loan to these directors, that is 10 directors and 5 directors, automatically it is a prohibition. We are not supposed to do this. This will come under a different reporting requirement. So initial stages we need to understand where we are. So we need to obtain a list of all the directors and check whether loan has been given. Loan, we have already understood what a loan is, right? So these are the documentation which we have to take, because again if you read the NFRA order, the one thing that they have told is, you are telling me that you have done everything, but show me the proof. So director cannot say, I promise I did everything. Where is the proof? And as we know, SA 230, audit documentation is the irrefutable truth. So once you show in the working file that I have done it, then they will not do anything. So as much as it is very harsh, we should introspect and figure out where we are going wrong. That is one thing. And if these normal things, if we are not able to find, we again need to introspect a lot, is what NFRA has told. That is about it. So first, that is out of the picture, director of the lending company or its holding company. So now we understood. So again to repeat, 10 directors, 5 directors under 185 prohibited. 2 directors, it is 186, not 185, 186 comes under 186. Next they talk about relative of such director. Relative of such director. So basically, if Y Limited with directors XYZ is giving loan guarantee security to a relative, let's say Mr. X, who is in turn giving loan to Director X. Is this covered? No. This is also completely prohibited. So I cannot do any indirect loan. If director is not able to take, I cannot give it to the relative. Next question comes, who is the relative? Should I see the Income Tax Act? Should I see the Companies Act? Or should I see some other law? Should I see Ind AS? Who is a relative? So for Companies Act purposes, relative is defined very, very clearly in company law itself. 2 clause 77 read with the rules. Very, very simple. Person is covered. The spouse is covered. None of the spouse's side is covered. Right? So no father-in-law, mother-in-law, they are not relatives as per company law. Then we have for the person's siblings, brother and sister, and the person's parents, father and mother, and the person's children and their respective spouses. This is the exhaustive list of relatives under Companies Act. So we may have different relatives definition in income tax law and in Ind AS, but here it is very, very exhaustive. Just this relationship, one generation up, one generation down with their respective spouses, and we have the siblings, and for that person only the spouse is covered, nobody else. So if I were to have, it could be plus or minus obviously, if I were to see this particular chart, for the person you have 1, 2, 3, 4, 5, 6, 7 and 8, 9. 9 relationships, that's it. So basically, if I saw that entire chart of 10 directors, 5 directors and 2 directors, let's take 5 directors of the lending company. So I should take a list from the company of all the relatives of those directors, just to see for my documentation. Again, it's an important statutory audit point. Documentation, I should take the list of all the relatives of each of those directors to see whether the company has given any loan, guarantee, security to those people. That is the second point. Third, it talks about partner of such director. Partner of such director. So if you see Y Limited, directors XYZ, director X is the director, and let's say they have a firm called XPJ, X, P and J. So in case Y Limited has given a loan to any of these people, that is P and J, who are the partners of that particular director, then again there is a problem. The law says nothing doing. You cannot give a loan to P and J because anyway X is not covered. X you cannot give a loan anyway. Instead of X you are giving it to P and J. Total prohibition. So the most important 4 things that we need to keep in mind is director of the lending company and the holding company. Then I have to look at the relatives of all the directors, partners of the directors, So this is what I need to see. This would be prohibited. So in this regard, we'll just have one more question, which is again very, very interesting because this went to the Supreme Court. So let us just create that. 3 questions, we are done with it. Let's go to the 4th one. Right. So in this question, relatives and partners of how many directors should I consider? Should I consider only relatives and partners of 5 directors? Relatives and partners of all 17 directors? Relatives and partners of 15 directors? Or what is it? First we spoke about directors. Directors, what was the decision? Directors of the lending company and the holding company. That is 5 plus 10, 15. Now I am not talking about the directors. I am talking about the relatives and the partners. Relatives and partners. Should I see those, for example, relatives there are 9 relationships. So should I see 9 into 5, that is these 5 directors here, or should I see 9 into 15, or should I see 9 into 17? What is the list that I have to take for my audit file under SA 230 is the next question. All this is given in the guidance note also. We are just repeating the same thing with some illustration. So you may kindly answer that. So is it the relatives and partners of 5 directors alone, because that's my lending company, or is it the relatives and partners of all 15 directors, or is it all 3, 17 directors? So you may answer that. So let us see. Okay, so 52% of you have said that it is 15 directors and 23% have told it is only lending company directors, whereas 23% again have opted that it is all 17 directors. Again, majority is right here, it is 15 directors. because there is one word, just one word in the Bear Act in section 185 which will give us the answer. It says, or any partner or relative of any such director. On this word such director, it went to the Supreme Court. In the case of Ambalika Das versus Hulsiya Shaw, Supreme Court said when a word such is there, an adjective such is there just before a noun, the meaning should be taken from the preceding sentence. So when I say such director, it is the director of the company or the holding company. So many of us will not take the list of all the 15, but as per the Supreme Court judgment and also as per the guidance note, we need to take the names of all the 15 directors. Otherwise, again, it may lead to professional misconduct because of lack of documentation. That guidance note is absolutely clear about it, that all the directors' names have to be mentioned and taken on record along with a written representation under SA 580 that loans have not been given. Apart from that, we need to do additional checks, which we will discuss while doing the statutory audit of the company. So you are 100% right. So the relatives and partners of how many directors to be considered? All these people. So if you see let's just now come back to one more point and then I'll just take you through what exactly happened in CCD to just give a different flavor to the discussion. So first part we saw was directors of the lending company and the holding company. Second one we saw relative of such director. Third one, partner of such director. Now there's one more point which speaks about, this we have done already. The fourth one is speaking about, yes, this is firm in which such director or relative is a partner. Now this point is there in the page number 10 of the NFRA order, which I'll take you through, where is a practical scenario which happened in Coffee Day. So if you take a scenario of Y Limited, directors XYZ, and director X is there, and X has a firm XPJ, and with XPJ as partners, and we have already discussed that if you give it to X, it is not allowed anyway. If you give it to P and J, it's not allowed anyway. What if I give it to the firm instead? What if I give it to a firm in which the directors themselves are partners? What if I give a loan to a firm in which directors themselves are partners? That is one question. And then what if you have a relative of X also, and they have a separate firm, ABC, and you are giving to that particular firm as well, firm ABC, would this be covered under, what do you say, a prohibition? So I repeat, you are giving a loan to a director anyway not allowed, to X is not allowed, to P not allowed, to J not allowed, we saw in the previous case. But what if I give it to a firm XPJ, point number one. Second one, if this director has a relative Mr. A, and he also has a firm ABC, what if the loan has been given from X Limited to the firm in which the relative of the director happens to be a partner? So 100% prohibited again, because the law says any firm in which such director or relative, happens to be a partner. Any firm XPJ and ABC in which such director or relative is a partner. Which means if the company has given loan to firm XPJ or firm ABC, then it is prohibited as per Companies Act. Reporting will be in a different way. Very interesting to know, in the Coffee Day case, they first gave it to firm XPJ. That happened to be a partnership firm in which Vijay Siddhartha and Malvika Hegde were partners. Then I think Malvika Hegde's relative is Mr. Raghavendra Hegde. He also had a partnership firm. So they gave it to that firm also. So that is also prohibited. Then in one more case, they actually gave loan to the relatives, other partners, B and C. So my question to you is, if the company has given loan, to X, it is prohibited, P and J prohibited, Mr. A prohibited, firm XPJ prohibited, firm ABC prohibited. But as seen in Coffee Day, if at all I give it to B and C, who happen to be the partners of the relative of the director, very deadly point, partners of the relative of the, unfortunately we have to do all this, right? Partners of the relative of the director, B and C, is it prohibited or allowed? Allowed. Under which section? Is it prohibited or allowed? It is not prohibited for sure. Is it allowed? Yes. Under which section? Again 186, because 186 says any person. Who is that any person other than the ones called under 185? So in that particular case, I'll just show you now the modus operandi of what happened in the Coffee Day case. I just made a quick chart here for your illustration. I'll share everything with you. So if you see, very interesting to note, we need to understand because this is the dynamics of 185. There was a company, Coffee Day Enterprises Limited, CDEL for our discussion purposes. Chairman and Managing Director happened to be VG Siddhartha, and they had so many subsidiary companies, Coffee Day Global, Tanglin Development, Tanglin Retail, Giri Vidyut, Coffee Day Hotels, Coffee Day Trading, CDEPL, all subsidiary companies, and they had all diverted the funds to Mysore Amalgamated Coffee Estate Limited, in which the father of VG Siddhartha had around 92% stake. But the interesting part is this, is what I am saying, that here, if you see, I'll just show you the page 10 as I was mentioning of the report. I will be sharing this entire NFRA report with the important pointers marked in also for our analysis here. So, obtained the balance sheet of MACL for FY17 and observed that it had given loans and advances to of 2,252 crores to related party, out of which 1,878 crores was given to a partnership firm in which Mr. VG Siddhartha and Malvika Hegde were partners. So this is a direct violation of section 185. This indicates indirect lending to director in which the directors are interested, and none of the provisions of 185 was followed. None of the provisions of the guidance note were followed. That's the reason why they have the penal provisions there. So this is a very practical example of what exactly happened. This is one part of the story. Apart from that, we also had this example where CDEL has given a loan to a subsidiary, that is Coffee Day Global Limited, CDGL, and there is one more company, Coffee Lab Limited. So Coffee Day Global Limited had a 99% stake in a partnership firm, mind you. Coffee Day Global had a 99% stake in a partnership firm, and that partnership firm's name was Classic Coffee Curing Works, CCCW, and Coffee Lab also has a 1% stake in that. Interestingly, Coffee Day Global Limited, another company, subsidiary company of the Audit company, this is the Audit company, subsidiary company has given a loan to a partnership firm. And the best part is what happened next. That partnership firm in turn diverted the funds to one of the relatives of the promoters. So, and then it was all round tripping of loans. Kumar Hegde then eventually gave it to Coffee Day Global, then again to CDEL. So it's a very interesting case. So all these are blatant violations of 185 and 186. That's the meaning of the word directly or indirectly. So you cannot give the loan even through various subsidiaries or to partnership firms, and eventually where is it going? It is going to the person. So if you, the NFRA is very clear about it. These things had to be audited. These things had to be checked. I understand that the time is limited, but even the basic things were not done. In one of the other talks that I was listening to, where the NFRA chairman told something which was very shocking, but it is unfortunately true in some cases. He said, I totally understand if the auditor cannot check a needle in a haystack. I will repeat it again. It's absolutely okay if an auditor cannot check a needle in a haystack. But it is amusing for me if he doesn't see the elephant in the room. That is what he said. He said, needle in a haystack, no problem. It's very difficult to pinpoint that small thing, that's okay. But if you are not able to see the blatant elephant in the room, and if you are not able to identify that, then what do you speak about professional judgment and professional skepticism? So that was what, unfortunately, he had to tell in a CA seminar. I was also part of it. Unfortunate. I'm not saying all of us are like, all of us definitely do our work and we uphold our profession to the highest degree, but these cases should act as reminders for us to fine-tune certain areas which we have probably not been looking at the importance with which it is needed. So coming back to this, 185.1 only speaks about 4 areas which are prohibited. I repeat again, director of the lending company and the holding company. In my example, 5 directors plus 10 directors, totally 15. Second one is partner of such director. All the partners of those 15 directors I need to take a note. Third one, relative of such director. So all the 9 relationships that I saw, 9 into 15. So 135 relationships I need to take a note of. It can be plus or minus. All should be part of my working papers. Fourth, any firm, any partnership firm in which the director or a relative happens to be a partner. So we need to look at firm XPJ and firm ABC. Suppose like in Coffee Day case, in one of the other scenarios, if at all I give it to B and C, who happens to be the relatives of the, partners of the relatives of the director, then they say no problem, I cannot give so many restrictions. However, for those two cases, you need to follow 186. So this was regarding a discussion on 185.1 only. Now we'll have to move to 185.2. In 185.2, this was a complete change in 2017 Amendment Act. They relaxed the provisions of 185. They said no problem. To these three companies which I am going to show you now, you can give a loan, but you have to take certain permissions. You have to take certain permissions. That is your board resolution, special resolution, and it should only be used for principal business activities. So this is the entire structure here. In this particular case, you have given a loan to all these companies. That is, these companies have given a loan to Mysore Amalgamated Coffee Estate Limited, no problem. So this loan was given by the main company CDEL. In fact, directly they have given the loan, indirectly they have given the loan. The question they are asking is, okay, if you are assuming that these are covered under 185.2, question number 1, have you taken board resolution? Shockingly, in many of the cases, board resolution was not taken. Second question, have you taken special resolution? And in most of the cases, special resolution was not taken. And even though both the things were taken, in some of the companies they had not taken. I mean, the third point in 185.2 is the loan should be used purely for the principal business activities of the company here. The loan should be utilized for the principal business activities. So the third question that they are asking was, did you use it for principal business activities? In all these cases, it was merely round tripping of the loans, diversion of funds. Nobody ever used any of those 2000 odd crores for principal business activities. So that again, that's the question as to all these 3 points also should have been considered. So what are the conditions we will see, but what are the companies that are covered we will see now. First one, private company in which such director is a director or member. So if you see Y Limited, directors XYZ, director X we have, who is actually a member of J Private Limited, and who also is a director of one more company, P Private Limited. So this particular section says a private company in which such director is either a director or he is a member. So if loan guarantee security is given to either P Private Limited or J Private Limited, is it prohibited or allowed? Allowed, but 3 conditions. First condition, board resolution. Second condition, special resolution. And special resolution is 75% majority of the shareholders have to take a special resolution. And in some of the cases in Coffee Day, they had not even sent the notice. How many days notice is required as per company law? 21 clear days. In most of the cases, they had not even taken the notice properly. So they had not even given the notice properly. So tomorrow was the meeting, they just sent one random notice and closed it. So there are a lot of issues which had happened. So here what I am saying is 185, it is not prohibited, mind you. It is not prohibited, but 3 conditions have to be satisfied. As discussed, board resolution, special resolution, and most importantly, auditor has to satisfy himself with proper documentation that the loans were used for the purposes for which it was taken. The loan was to be utilized by B Private Limited and J Private Limited for the principal business activities only, not for fund diversion. So in that regard, I had to take a management representation and also need to do some test checks as per the guidance note also to ensure that this is not, this is not the idea of fund diversion. There is one part of the story, but an interesting dimension to that is in case I have a relative, Mr. A, and they also can be members and directors of any other private company, no problem. So you can have a relative of X who's Mr. A, who's a member in R Private Limited and who's a director in Q Private Limited. Now the question here is, if I give any loan, guarantee, security to Q Private Limited and R Private Limited, my question to you is it covering under 185.2 or is it 186 for reporting requirements? 185.2 or 186? 186. Because as you can see, any private company in which such director or relative is not there, in which such director is a director or member. So you are 100% right. These, when I say cross, it means 185.2 will not come. 185.2 will not come. When I put a cross mark here, it means 185.2 will not come. But what will come in these two areas? I would safely say that in these two areas, section 186 will come. 186. So this is governed by 185.2. And in 185.2, auditor has to satisfy himself that three things are taken care of. One is loan has to be, whatever you are giving the money, it should be sanctioned by a board resolution. And in Y Limited, you should call a valid meeting 21 days before the meeting and take a special resolution. And lastly, it should be principal business activities in both P Limited and J Private Limited and P Private Limited. But if you are the auditor of, let's say, Y Private Limited, then can I give a loan, etc. There are certain exemptions, as I told you, we will see that. So the first thing here is private company in which such director is a director or member. Moving on, one more thing. This is very simple, we can go fast. Any body corporate where 25% of the voting power is held by the directors. So if you take an example of Y Limited, who is giving a loan guarantee security to a body corporate, and basically the directors of either X and Y Limited together are holding 25% of the shareholding in this body corporate. So body corporate can be a private company, public company, statutory corporation, foreign company, limited liability partnership, financial institution, anything for that matter. So if the lending company Y Limited is giving loan guarantee security to any body corporate, but that body corporate is controlled by the directors, how much? 25% voting power. Then they say, no problem, this also the same three conditions, that is special resolution, board resolution and principal business activities. That is what they say. Very simple. So this is fine, this is something very same, but then people, again you have to take a management representation for this. But the previous one was more important because it's a private company. This is no problem, you can take a management representation and close it. Last but not the least, there is again interesting point, any body corporate in which the board of directors is accustomed to act, they say. So Y Limited is giving loan guarantee security to a body corporate in which the directors of the lending company are controlling the entire board of directors of this company. They are controlling the board of directors of this company. This is a classic example what we saw here. If you see in this example, that is why this entire issue came. CDEL, who is the chairman and managing director VG Siddhartha, was fully controlling this MACEL, Mysore Amalgamated Coffee Estate Limited, through his father. That was what was the findings came to the father. Father was actually bedridden for many years. How could he be the shareholder and director of 91.75% of the shares of MACEL? And interestingly, Shri Vijay Siddhartha was not even the director of MACEL. But that is the beauty. This case has actually given the true meaning of this word, accustomed to act. So accustomed to act is not a reason of like one or two incidents, but you are habituated. So in that particular case, he asked his father to give around 20 checks, blank checks signed. That is what the NFRA says, blank checks signed, and whenever he felt like he had to hand over the checks. So blank checks. So basically, ultimately, the entire company was controlled by Shri Vijay Siddhartha. Was he a director on the board of MACL? No. That's the beauty of the word accustomed to act. Accustomed to act. So this is a classic example of 185.2 again, whereby this was a body corporate which was accustomed to act according to the whims and fancies of the directors of the lending company. Who was the lending company? Coffee Day Enterprises Limited. And mind you guys, this is a listed company. Friends, this is a listed company. So think about this, a listed company, all these things happened. That's why it opened a Pandora's box. What was the independent directors doing? What were everything doing? And in the letter which he wrote just before he committed suicide, he has mentioned that this was the sole act of only me. Nobody was involved in this. Auditors did not know. My other directors did not know. Independent directors did not know. I was one person acting on all these things. So if possible, kindly forgive is what he mentioned. So if I see that again, we get to know the real meaning of the word accustomed to act. So So the intention of this session is not to dissect this entire thing, just to give a practical example of what do you mean by accustomed to act. That's the only intention, nothing else. What has happened has happened. You look at the future now. So yes, body corporate in which accustomed to act. So even in this, you have to do three things which the auditors failed to do, which we have to do from going forward. One is board resolution, special resolution, and I need to ensure that MACL is using it for its principal business activities. But unfortunately, MACL now started giving the loans back through various relatives, etc. They did something called as round tripping of loans. That's called round tripping of loans. That is what they actually did. Unfortunately, that's what it is. So, for example, this is called round tripping. So, if you see CDEL, that is a company which is owned by Vijay Siddhartha and was the promoter, through its subsidiary TRR DPL, gave a loan to MACL, which again is indirectly controlled by Vijay Siddhartha. 789 crores of public money, 789 crore of public money, which was again repaid to CDEL through simple accounting entries. I just gave a check with that money and wrote it in the accounts that yes, loan has been repaid. Those checks were not even deposited in the bank. And later when I deposited that money in the bank, the moment I got the money from MACL, immediately they transferred the money back to MACL. Imagine. So I gave a loan to you, you repaid to me just before the balance sheet date. I put it in the account saying that loan has been repaid. I encashed the amount. Then the next day I transferred to you through various sources. Because it's like I've taken the repayment of loan from you, again gave you a loan. And that concept is called evergreening. This is also a new concept which I didn't know, which I learned. It's called evergreening. So evergreening is that concept where I give you the loan, I take the repayment, again give you a loan. So evergreening of loans and all these related party transactions that happened. So this is a classic example of accustomed to act and the entire subsidiary scene, etc. So in this 185, can I give a loan to subsidiary is one more question which we need to answer. Is that possible, or I can just directly giving we already saw, but through the subsidiary can I route is one more question that we need to clearly answer. So of course shortly we'll take a coffee break. I understand it's a very heavy session. But it is what it is. It is what is needed. Only when we understand 185 properly can we go to 186. So either way, this is what it is. So basically, again I repeat, what are the things which are prohibited, just to revise? That is the directors of the lending company, loan given by company to directors of the lending company and directors of the holding company. Point number one. Second one was relative of such director. Third one, such means all 15. Next is partners of such director, means again 15. Fourth one was partnership firm. Any partnership firm in which the director or relative happens to be a partner. These four are completely prohibited. But these three are allowed with restrictions. Point number one was private company in which director is a director or member. Second one is the body corporate in which 25% is controlled by the directors. Third one is a body corporate like for example MACL, which is accustomed to act, where the directors are accustomed to act according to the directors of the lending company. So that was accustomed to act provisions. So all these were unearthed, and the auditors unfortunately felt that 185(2) also was never applicable in those cases, where NFRA has clearly given an entire mention about what is 185 sorry, and what should have been done and what was not done. So these are the points that we need to keep in mind. In that regard, just one more question, couple of questions, and then we can take a coffee break. Yes. So next question. This is an again interesting area. Loan is given by Reliance Industries to Vantara Trust. Vantara Trust is created by his son, in which he is a trustee. But let's say in this thing, he's also a trustee, happens to be a trustee. Now tell me, this also happened here in the Coffee Day case, where the loan was given by CDEL to many trusts as such, in which Vijay Siddhartha happened to be a trustee. Now, if any such peculiar scenario comes during our audit, according to you, is it prohibited under 185, allowed under 186, or is it allowed under 185, or is it none of these? This is again a practical question which can come. So you can just, I gave an example of Reliance and Vantara, but it could be anything for that matter. Yes, I'll just give 10 more, 20 seconds for. as whatever we have discussed now, was trust covered? No. So obviously it will not come under 185. So let's check it out. Yeah. So right. Is it allowed under 186 though? Is the question. And is it allowed under 185, 186? What is the question? So you are 47% of them are right, 100% true. It is allowed under 186 because 186 covers person. Now person, again I have to go to income tax definition. That will, because there is no definition of person in our Companies Act. So I have to go take the help of income tax. Income tax, as you know, they want to tax everything that moves, everything that is there. So obviously income tax says everything is a person. So trust is a person. So again, if I have to give a loan given by Reliance Industries to Vandara Trust, then that will come under section 186. Everything will apply. So that we have to go to the other thing. So in this case also it was not done. So that is one more question that we need to see. So moving on. Okay, this we shall just a second. Okay. All right. So there is one more interesting question which I have taken from the Coffee Day case only, but I have just given different example. Is this allowed though? Reliance Industries Limited gives guarantee or security to Mukesh Ambani, and Mukesh Ambani in turn gives loan to Mr. Vijay Mallya. So in this case what had happened was Coffee Day CDEL had given guarantee or security to VG Siddhartha, and VG Siddhartha had given a personal loan to some Mr. Raghavendra Hegde or some person like that in that case. So I've just changed the meaning to this. I mean just a example. So is this possible or is it prohibited under 185? So again we have these four options. Prohibited under 185, or is it like I need to take board meeting resolution and I need to take unanimous approval? This is nothing but 186. Under 186 I need to take board meeting resolution which has to be unanimous. Means all the directors should agree. And or can this entire thing be delegated to Mukesh, Mr. Mukesh himself, where he can only give the loan, or none of these? So this is it prohibited under 185, where Reliance gives guarantee or security to one of the directors, and the director is giving loan to some random person. It's very weird, strange transaction. So I am the director, I am giving to a random person, but I am taking guarantee from the company. Strange. It has happened in Coffee Day also. So these type of transactions are happening. It may happen in our practical life when we are doing the audit as well. So the question here is, as an auditor, how do we report this? Is it, prohibited or is it allowed? So we'll just see I'll just open the BEAR Act for our immediate interest. So if you see here, the answer is in these two lines. Answer is in these two lines. No company shall, directly or indirectly, advance any loan, including any loan represented or booked. Okay, that's fine. In this line actually, or give any guarantee or provide any security in connection with any loan. Unfortunate wordings, taken by. Loan should be taken by whom? Director. Loan should be taken by director. It's unfortunate, but in the old law, 1956, different wordings were there. In this, they are telling loan should be taken by director. In this particular question, is the loan taken by director or guarantees taken by director? Guarantee. So unfortunate as it may seem, this will not be covered under 185. It is not covered under 185. So I'm sure majority of us would have opined that it is covered prohibited under 185, but it is not. It is not. Actually, 5.26% of you got correct answer. It is board meeting resolution and unanimous approval because of the shoddy wordings, and that has been upheld in the court also in many cases. This particular strange transaction has happened in Coffee Day also. It is not prohibited under 185. So because they have clearly mentioned in connection with any loan taken by the director. Has the director taken the loan? No. Director has taken the guarantee or security. So in the old company law, they had given the line in connection with the loan taken by any other person on behalf of or to any other person on behalf of. So that covered everybody, but that was strangely removed in 2013 for reasons best known to MCA and the lawmakers. So this kind of transaction is not covered, and even this was used by Mr. Vijay Siddhartha to sort of, circumvent the legislation, and even this part was missed out by the auditors. And again, because of which it was part of the finding as well. So this finding is not a standalone finding. There are 5 to 6 other reports that we need to read. So I am just trying to give a practical example of all the reports, and then also trying to tell what we should check in the thing. So in case any strange transaction happens in your company in which you are auditing, you should understand that it is not prohibited under 185, which most of us actually felt. It's true. Substance over forms, we see that, how is it not prohibited? But unfortunately, wording such as otherwise have been upheld in the court as well, and unfortunately it is allowed. But it is allowed under 186, but we need to follow those provisions. Board meeting resolution, unanimous approval, wherever needed special resolution, all those things we anyway have to take, but if it's not taken, then it's more of a problem. 2 more points, we'll wind up with this. Now, direct loans we have seen, indirect loans, they have clearly mentioned through various cases that there should not be any round tripping. So one of the examples I've already given of round tripping, but let us see the exact wordings of the NFRA order to understand the modus operandi of the same. So if you see, the auditor did not check the bank statement of CDGL to verify the management explanation that 130.55 crores was recovered from CDGL. So if you see, that loan was rotated 7 times, same loan, through CDGL, MSCL, CCW and Kumar Agri to show the repayment of the amount. For example, they are telling the bank statement of CDGL and MSCL shows that on 9th May, CDGL paid 20 crore to MSCL, which then paid 20 crore to Kumar Agri, which then paid CDGL 20 crore and again then paid MSCL. And mind you friends, this is a listed company, right? It is like alt tab that we do in our system, which I am doing now. That is how the loans were transferred from one company to another company. It's a listed company, public funds. It is very, very unfortunate, right? So this is called round tripping. This round tripping has to be avoided, is what this line I have taken from the guidance note. So they said there cannot be any guidance note issued by ACI. They said auditor has to ensure that there is no round tripping. And they've used a nice language, any form of subterfuge should be avoided, where we should ensure that people have not done this, which we are glaringly seeing in this thing. Then as we already saw, loan given to a trust or even loan given to a Hindu undivided family is not covered under 185. Let's say the loan is given to a HF in which the director happens to be a Karta. It is not covered under 185. Strangely, it is now coming under 186. Law cannot provide for all possible circumstances. You have to make a stop somewhere. It has stopped in that dimension that we have to check. So it will not come here anyway. All this is fine. So ultimately, they have also told one more thing, that if you see the WARE Act here, there may be many cases where the company has given performance guarantee also. Company would have given performance guarantee on behalf of a director, saying that he would definitely perform his duties and he would definitely, the contract would definitely be honored. Are performance guarantees covered? Was a question raised to MCA. So they said no, because if you see here, there is one line, in connection with any loan itself. So the guarantee or security should only be in connection with the loan, not with any performance guarantee. So in case the company has given performance guarantee to somebody else, to the director, and director has given, taken a loan or whatever, entered into a contract, whatever the case may be, entered into a contract, not a loan, entered into a contract, then those guarantees are never covered under 185, never covered under 186, never covered under 179 also, because all these 3 things only talk about connection with the loan. So basically that is again one important area, in connection with a loan. So in our audit, if they have taken any performance guarantee, no need of any approvals except a simple board resolution, which is anyway given under 179(1). Because as per 179(1), whatever the company could have done, if company had brains of its own, who will do it? The board of directors. So the board can simply pass a resolution saying that, yeah, okay, no problem, so you can take a performance guarantee. So one more interesting part is, it should only be in connection with a loan and nothing else. It should only be a loan and absolutely nothing else. Right. Supply of goods to director on credit, that also we have already discussed. Auditor has to use his professional judgment to see that whether it is actual credit or whether it is a loan disguised as credit, and then accordingly do the needful. What about loan given by company? Many of our companies which we do the audit, director's spouse will be the accountant, and the company actually gives money to the salary to the accountant, who is the spouse of the director, and also they would have given loan to the employee. So now I need to see whether just because that person is the spouse of the director, will 185 get attracted, or should I see the facts of the case? So many such things happen where 2 to 3 people of the family members only will become the, all our private companies are like that, whereby 2-3 people of the family members only are the directors, they are the employees also, loan is given to them also. So in that case, again we have to take the help of case law, which clearly says these things. Whether the beneficiary is a bona fide employee. So if the spouse happens to be an employee in good faith, then 185 will not come. Whether the advance falls in the general scheme of advances given by company to the other employees, no problem. So if it's the advance given by the company, all other employees also getting the same money, she is also getting the same money, no problem. Spouse is also getting the same money, no problem. Whether the amount paid is disproportionate to the salary. Let's say the husband is the accountant here and the wife happens to be the director. So husband's salary is 40,000 rupees per month, but he has got a loan of 20 lakhs. Then again I need to see, isn't it disproportionate to the salary? Then again, conditions of repayment. Is there any rate of interest? Have they given an interest-free loan? All that I need to check, because as per Companies Act, even under 185 and 186, interest-free loan is not possible at all. If it's interest-free loan, again it is an issue. And lastly, whether there was any laxity in the recovery. Was it being recovered or no recovery done? That also I need to check. And what is the capacity of the person receiving the advance? Whoever is receiving the advance, is he actually an employee, not an employee, what it is? Everything I need to clearly check. Okay, so again, loan and debt, all that we can just skip this. Right. Then last part before the break, we'll just wind up with 185 and then go to 186 after the break. This section is very simple. The wordings only says nothing contained in subsection 1 and 2 shall apply to this section. So 185.3 says 185.1 and 185.2 will not apply at all. So here they are giving loan to MD or whole-time director. Now this is a very interesting part. You can actually give a loan to managing director or whole-time director. Very strange, but it's interesting because he is working in the company full-time. He should get some benefit, and that benefit is giving a loan. However, this loan should either be sanctioned in the conditions of service itself. In the employment agreement only I should say what is the loan arrangement, or in case conditions of service are silent, they say you should there should be a scheme approved by the members by a special resolution. So in case any managing director is taking a loan, managing director is getting a loan from the company, Companies Act allows that to happen, but 2 conditions should be satisfied, either of the 2. One is it should be part of the deal, conditions of service, or it should be a special resolution, which means ultimately go to the shareholders. If they agree, then we can go ahead. If they agree to do the needful, then it is possible. So that is what it is. That is the managing director or whole-time director. Then the second one is a separate thing altogether. If you are in the ordinary course of its business, if it is providing loan or guarantee, a company which in the ordinary course of its business providing loan or guarantee, however, you should charge an interest rate of, government rate of 1 year, 3 year, 5 year government security. So this also went to the court. Now I'll ask you a question and then we can stop for a break. The question here is very simple. If you see the wording here, this went to the court, this particular line. Does this exemption apply to all companies which have extra money on hand? They would want to invest this money, and in the ordinary course of the business, they invest it in the director. They are saying that, look, okay, I have extra money. Rather than investing somewhere, let me give loan to the director. But I will ensure that I will maintain the government security yield rate. Is it like that? Or this section applies only to financing companies? This went to court. Will this apply to only financing companies? So the argument was ordinary course of your business, itself is financing, or any company in the ordinary course can give loans. Was a doubt raised, valid doubt actually, which was raised, because if I had to say financing companies, I could have written financing companies. Why would I say in the ordinary course of its business? That was a valid doubt. So they had given some excess funds to director in one of the cases, excess funds to the director, and when they got caught, they said, look, it's allowed under 185(3). I have excess funds, I have proof, I don't want to invest anywhere else, I am giving to the director, but I have given these, correctly I have given the interest rate is higher only, more than the government security rate. So what is the issue was the question. Whereas the other party took it as, no, it should only be finance companies. So what is your opinion on this? Finance companies or any company? Finance company. If you say finance companies, what makes you say so? Is there any particular word here or any particular line? Basically, our answer will be in this only, in this line.
Ordinary course.
In the ordinary course of its business. So I am asking in the business it can be ordinary course to give money to anybody. That's my ordinary course. Or should my main business itself be financing? Yes, so the court, you're 100% right. So the court looked at only one word, its. They say the ordinary course of its business. So they said the business of the company should be financing. If it were to be the other logic where you can give loan to anybody, then they said it should have been positioned here. They said in its ordinary course of business. This was a Supreme Court case law. Right? They said in its ordinary course of business. If the wordings were to be in its ordinary course of business, then during the course of business you can give it to anybody, no problem. But since they used the word in the ordinary course of its business, then it said that the business of the company only should be what? Giving a loan. So ultimately they should only be for financing companies. Now why is law so tough? Because otherwise nobody will come to us. Right? So nobody will come to a chartered accountant. So I always say in good humor that company law or taxes law of the CA, by the CA and for the CA. So on that note, let's take a short break, and if you have anything to share, you can share now, and we can all meet over coffee, and then again we'll come back. We still have just finished 185. We have not even gone to the other 186 section and also the cargo provision. So we will just cut short. We will see what are the important things to do. We will definitely cover everything, and that's about it. So thank you. I think we can have a short break. Thank you so much. Thank you. In this session, we will be talking about 185. We'll finish it and go to 186 as well, and then look into the other areas of CARO reporting, understanding the clauses of CARO and how to report by doing the statutory audit.
There is some.
It's just straight for the
correct.
Please switch on.
Correct.
Okay. So I think I'm audible.
Number share.
Alright, so subsection 3 of we were doing section 185, we finished subsection 1, we finished subsection 2, we try to understand it practically how it happens. Now moving on to subsection 3, which again we have done. So it says nothing in this subsection shall apply to, as we discussed, managing director, whole-time director. You can definitely give a loan, no problem. As part of the conditions of service was one point, or they have to pass a special resolution. And second is what we saw is in the ordinary course of business, whether I am providing loans or guarantees. Now in this particular case, as we have seen, is this allowed though, whereby a holding company, can it give loans to subsidiaries? You would have seen many holding companies giving loan to subsidiary companies. So two important things we have to discuss is, first of all, can a holding company give loan to subsidiary without following section 185? Second question is, what if the lending company were to be a private company? That is what all of us actually, most of the audits are private company audits. So is there any restriction or what are the exemptions? So we need to look at the practical aspect of the exemption as well. So first is this one, Corporate Enterprises Limited, listed entity, can it give loan to various subsidiaries, which it had in fact given, and through these subsidiaries, can it again give it to some other subsidiary? Is it allowed or not? And to that extent, how many subsidiaries can one company have in the context of the new law after 2017? And even if it is making an investment through various companies, is it possible to do these investments beyond certain layers of investment companies? Is a combined discussion that we need to have, one after the other. So let's first discuss, can a holding company give a loan to its subsidiary company without following section 185? And in case 185 is not needed, which other section would be attracted? So let us again go back to the law. If you see here, you have the holding and subsidiary provisions here. So to summarize that, let me just summarize that whether it will apply or not apply. We will summarize that portion. I just want to this later. Yes. So ultimately, after the Companies Amendment Act 2017, a holding company can definitely give loan to wholly owned subsidiary company. Provisions of 185 will not come. Provisions of 185 will not come. Would 186 come is a question we need to answer in 186. We will see 186. When we are seeing 186, we will check. Mind you, it is only a wholly owned subsidiary, not a normal subsidiary. So if a holding company is giving a loan to wholly owned subsidiary, 185 provisions of 185 would not arise. And anyway, if you see, we never saw anything with respect to holding and subsidiary relationship in 185.1 or 185.2, which means definitely it is not prohibited. And even if it is allowed, there are no restrictions under 185.2. We have seen that already. So here we are just understanding whether 185.3 will come or not. As per the section, it says wholly owned subsidiary you can give a loan. So which means definitely 185 will never come. But will 186 come or not? We will have to wait till we finish 186. Moving on. Holding company is giving a guarantee or security to anybody, doesn't matter, anyone, who in turn is giving a loan to a wholly owned subsidiary. So holding company is probably giving a guarantee or security to a bank, let's say, and the bank is now giving a loan to a wholly owned subsidiary. So a wholly owned subsidiary of any company is approaching a bank for a loan. Bank says, okay, no problem, but I would like to get security not from you, or even if you give security, it's okay. Additionally, I want your holding company to give some guarantee security. These transactions also, in fact, are not covered under 185. Otherwise, it would become too restrictive. But is it covered under 186? We will definitely see this the moment we finish 186. Because we have definitely do such transactions in practical life. Third one. Holding company is giving guarantee or security to any bank or financial institution, which in turn gives a loan to a subsidiary. Now the difference between the two is here we have wholly owned subsidiary and here anyone is covered. Need not just be a bank, it could be any lender. It could be any lender. Whereas here they have removed the wholly owned subsidiary portion and they have only retained subsidiary. However, we have bank or financial institution. So these three cases, in all these three cases, section 185 will not come, but will 186 come is a different question. So again I repeat, holding company giving loan to wholly owned subsidiary, 185 will not come. Will 186 come? We'll check that. Holding company giving guarantee or security to anybody who in turn gives a loan to wholly owned subsidiary is one thing. Second one, holding company giving guarantee or security to a bank or financial institution, and here only subsidiary is covered. In all these three cases, you can freely do it without the rigors of section 185. But will 186 come? We will just check that shortly. So moving on, we also told that the guarantee or security, the managing director can get provided two things are done, either of the two things. One, it should be part of conditions of service, or there should be, you should have passed a special resolution. In that regard, we have a last quiz question. After that, we will, of course, there ends the entire 185. So, right. So, this is a scenario, let us say. Reliance Industries gives guarantee security to SBI because SBI has to give a loan to, let's say, Mr. Mukesh. So, if Mukesh goes and says, I want a loan, they say they'll give a loan, no problem, but please hand over the guarantee or security to from Reliance. So, this is definitely in connection with a loan, no doubt about it. So, my question to you is, guarantee given by Reliance Industries to SBI was lent money to Mr. Mukesh, who is the MD of Reliance. This is done via special resolution by shareholders. As we saw, two conditions. One, it should be part of conditions of service or special resolution. In this example, it's already done by special resolution. This also I have taken from the entire CCD case itself, whereby the CCD had given guarantee to Standard Chartered Bank, which had in turn given loan to VG Siddharth. Actually, that's how it happened. So now my question to you is, but whether special resolution is passed, not passed, all that was auditor had to check. Now what is the answer? Is it allowed under 185(3) since it's an exemption given there? Does it require board meeting resolution and unanimous approval? or is it prohibited under 185, or what it is the question. So this actually happened whereby Standard Chartered Bank had given the loan to Mr. VG Siddhartha, and in turn had taken a lot of guarantee or security from various companies, which is the part of the Coffee Day group. So let's see what would be your response to this. Is it allowed under 185.3? Is it, or just board meeting resolution, or is it prohibited under 185? What is the answer? We'll just check that. I'll just give maybe 10 seconds more.
So instead of managing director, if he is chairman, then
If he's a chairman, then again this is not covered, because this section only speaks about what do you say, directors. So you can be a chairman and MD as Mr. Mukesh Ambani. So that's beside the point. This covers only directors, right? And it covers only the directors portion. It doesn't cover the chairman. If you are an independent director and you are a chairman, so that begs the question: can you be a chairman without being a director?
Yes, you can.
Yes, that's all. So those scenarios, no problem, right? For example, Narayan Murthy exited the board of Infosys and he was appointed as the chairman emeritus. So then in that case, no problem, because he would have been connected to the company before, but as of today, is he a director? No. But so in all other cases, if you are a MD, again managing director, what if the nomenclature is different? That also I need to check. Many companies have some weird nomenclature. When Mindtree used to be there, before being bought by L&T, Mr. Subrato Bagchi, who was the CEO of Mindtree, he did not have any designation called CEO. His designation was Chief Gardener. Imagine, his designation was Chief Gardener. So if you go to Mindtree and say, who's the gardener? Subrato Bagchi. Right? He is called as a Chief Gardener. So his agenda was, I had an opportunity to meet the man, very humble and nice man, many years ago. So I asked him, sir, what is the logic of this thing? Because when we had just started off, I just wanted to meet him to get some guidance. He had inaugurated one of our programs, I remember. So I told him, sir, what is the logic of having the term Chief Gardener? He said, Mindtree is like my garden, and it is a tree that I planted. And in order to nurture that, I call myself Chief Gardener. That was his logic. So is that also MD? Yes, because if you see the definition of managing director, it says by whatever name called. It's just that you need to have the substantial powers of management. If you have substantial powers of management, you can be anything. So it's a good question. If you have substantial powers of management given to you, even though you are not called as an MD, let's say you are simply called as a chairman, but you have to see the powers given to you via the agreement, then only you can decide who it is. So that definition is given in 2 clause 53 and 54 for your reference. You can check that. Anyway, so coming back to this question, so most of you would have answered. So let us see whether it is allowed or prohibited or whatever it is. Let us see how many. Okay, so 57.14% have told it is allowed. 14.29% have told it is prohibited under 185, whereas majority, almost 60%, have told it is allowed and it is possible to do this thing. So if I see section 185.3, nothing contained in 1 and 2, you are saying it's allowed. Nothing contained in 1 and 2 shall apply to, this is the key word here, giving of any loan to a managing director, not guarantee or security. So in our question here, I was speaking about guarantee or security, not a loan, right? So if Reliance has given a loan directly to Mukesh Ambani, that alone is allowed. If you have passed a special resolution or if you have taken conditions of service. This particular thing which was done in Coffee Day, whereby a special resolution was taken by shareholders, and interestingly VG Siddhartha's father himself is holding 97.5%, so he can only pass a resolution. That was ultra vires the Companies Act, because it's not, you are not supposed to do it, because the what is allowed here is just giving of loan, not giving of guarantee, right? So in that sense of the term, this also whatever was done was unfortunately illegal, and very strangely the auditor told it is allowed, because it is guarantee or security. Special resolution is taken, it's allowed. But again, NFR had to point out through various reports, not the current report, they said this entire thing is ultra vires the Companies Act. It is void ab initio, it is void from the beginning. You are not supposed to do it at all. So the answer to this is, it is 100% prohibited under Companies Act. Under Companies Act, under 185, you are not supposed to do this. So you cannot even pass this resolution like that. You are not supposed to do it. It gets covered under 185(1). It is like guarantee or security given to any other person in connection with a loan taken by Mukesh Ambani. So it is prohibited. If you pass any resolution allowing this, this does not have any base in the company law. This is also one thing that we need to see. Now comes the this is about it. So we have finished all the questions as such. That's fine. So thank you for participating. It was one way of trying to interact. Right. So now one more interesting part now, which obviously all of us have to know is, if I were to be a private company, can I give a loan? All our audits, most of it is private company audits. So can I give a loan is the question. So let us see. Now this is a very important notification that came way back in 2015. It's been almost 10 years now, but it still holds good. It says you can give a loan if you are a private company, provided all the three conditions are satisfied. Condition number one, no other body corporate has invested any money in your company, which means you are a pure private company. You should not be a company which is in the middle of an entire sequence where somebody invests in you, you invest in somebody. No. Basically, it's a pure private company doing business, point number one. Second one, you can definitely borrow money from banks. I'm not debarring you from borrowing money from banks. If you borrow money from banks or financial institutions or any other body corporate, whatever it is, it should be less than 2 times the paid up share capital or less than 50 crores, whichever is less. It should be less than 2 times the paid up capital or less than 50 crore, whichever is less. For example, if the loan that you have borrowed, let's say, is 60 crore and your paid up capital is, let's say, 20 crore. 2 times the paid up capital will be 40 crore. So it says whatever loan you have borrowed must either be less than 40 crore or less than 50 crore, whichever is less. Lesser of the two is 40 crore. They are trying to tell your borrowing, that is 60 crore, should be less than 40 crore. In this case, is it less than 40 crore? No. Hence, you cannot give the loans. They are trying to tell you should not have borrowed. So if you are a private company in the center, first of all, no other company should invest in you. Secondly, even if some bank loan you have taken, the borrowing that you are taking, let's say the borrowing is 30 crore. Whatever 30 crore that you are taking must be less than 2 times the paid up share capital or less than 50 CR, whichever is less. Less than 2 times paid up capital, that is less than 40 crore or less than 50 crore, whichever is less. Which is less of the two? 40 crore. So is 30 crore less than 40 crore? Yes. So such companies actually can give money to others. That's what they are trying to say. It can give money to others. Thirdly, if this is the condition where paid up capital was 20 CR, I'll show you practically also in one of the cases. So 2 times paid up capital, 40 crore, that's fine. And this is 30 crore, okay, that's also fine. Now 2 times is 40 crore. 40 crore or 50 crore, whichever is 40 crore. Now this company has only borrowed 30 crore. Now can I give loan to directors? Yes, it is allowed. I can give loan to all directors. 185(1) will have no relevance. You can definitely give loan to anybody. The section 185 will not apply. But third important condition is, in such a scenario where you have borrowed 30 crore rupees, there should not be any default in the repayment. The moment you have one default in the repayment of that loan, you cannot give any loan or guarantee to anybody. You cannot give any loan or guarantee to anybody. So basically, 3 conditions. In whose share capital no other body corporate has invested. Secondly, if the borrowings of such company from banks or financial institution is less than 2 times the paid up share capital or less than 50 crores, whichever is less. In my example, 30 crore. Third condition is, even if you have borrowed 30 CR, you should not have any default in repayment of any such borrowings. So let's take it. Any doubts in this? Yes.
The first point, share capital only, is it equity share capital or equity?
Good question. Is it equity share capital or preference share capital? In the absence of any information, we have to go to the normal meaning of share capital, equity share capital and preference share capital. Because they have not meant equity. Yes.
What if they have convertible?
Yes, convertible at the time of conversion only. I need to take it in mind. Not
even if they are compulsorily convertible.
Yes. That is one FAQ which was raised to MCA. Because if you see, that is a very good question. He is asking if it is compulsorily convertible preference shares, for example. Should I take it into consideration? For this, I need to go to the definition of. Just to add on to the question. If I go to the definition of subsidiary. in 2017 the definition was different. This was based exactly on what he's asking. So if, for example, if there is a holding company, it is investing in a subsidiary company, how much, what percentage would it be if to call it a subsidiary? It is more than half, as we know, more than half. More than half of what was the very, very valid question? Is it more than half of paid up share capital? More than half of issued share capital? More than half of total share capital? What was it? What is it rather? So it used to be total share capital. And they gave a definition of total share capital to be equity share capital and convertible preference share capital. Convertible could be compulsorily convertible, it could be convertible after certain conditions, whatever it is. So now this created an issue because many people said that even though I have preference share capital which is as of today not convertible, I am able to control the company as a holding company. So in 2017, this entire definition, this part was removed. And as it stands now, it is total voting power. So whenever law wants to tell you only that it is equity capital, it will be total voting power. If at all, wherever they say share capital, it will be equity share capital and whichever form of preference share capital. It could be compulsorily convertible or any other type of preference share capital. So to make, because this is a restrictive section, so we have to take it as not as equity share capital, it is equity plus preference share capital. So no other company should have invested in my company, share capital of my company, whether it is equity or preference, because the MCA did not want you to use that as a mechanism to give loan to others, because otherwise that again I will do, some other company will invest in preference shares in my company, I'll get in the cash and I'm using that money to again give loans to directors. To stop that from happening, they had given a clarification that share capital will mean equity and preference. Is that fine? So a practical example, so to speak, this is in Bhubaneswar Power Private Limited. So if you take up the notes forming part of the financial statement for March 31st, 2023, if you see the share capital here, now then again the next question, share capital when should I see? Date of the loan, or is it like for example as standing today, should I see as of today, August 2024? Or should I see the date of the loan? Loan also I am giving today. Should I see it today? Or should I see the immediately preceding, that is 31st March 20? Yes, sir?
Preceding audit.
Yes, yes. So they have given the definition even in 186. They have said it is the latest audited balance sheet. The latest audited balance sheet. So in this example, we obviously, it is the audited only itself, so I have to take the March 31st, 2023. So for all the loans given during the year, I should check the latest audited balance sheet. So in this case, it will be this. So whatever, this is the equity share capital that they have invested in, that's fine. Now, if I see the loans, if I see the borrowings rather, there you go, this is the borrowings of Bhubaneswar Private Limited. So from banks, they have taken money from banks and they have taken loans from related party also. They have taken loans from related party. So overall, it is this itself is around 3,900 lakhs, and the other one was 5,976 lakhs. Now my question is, can this company give loans? Let me just add the share capital here also for your reference. The share capital amount is 25,325 lakhs. 25,325 lakhs. That is the share capital of the company. This secured borrowing from banks will be around 5,000. I'll just put 5,000 lakhs. Whereas this is roughly around 6,000 lakhs. Let's keep it like that. Let's make it like a round figure. It will be easy for us to understand. Let me just make it 25,000, just for argument's sake. Yeah. So overall, paid up capital is 25,000 lakh, and loans from banks is 5,000 lakh. Unsecured loans is 6,000, and mind you, unsecured, this is borrowings from related parties. So what do you think? Can Bhubaneswar Private Limited grant loans to directors? Grant loan to directors? Yes, no?
No,
No. Why, sir?
because they are borrowing from body corporate.
Can't I borrow from body corporate?
You can borrow, but then notification is there.
No, sir, once again, I'll just come back here. Yes, here in this condition. Yes. in whose share capital no body corporate has invested. Has Tata, Tata company, has they invested in the body corporate, in the share capital? No. They just lent. Then you see, if the borrowings of such a company from banks, financial institutions or body corporate all put together is less than 2 times the paid up share capital or less than 50 crore, whichever is less. So in this question, should I take, practically speaking, should I take, should I take total borrowings to be 11,000 crore, 11,000 lakhs or 5,000? 11. Total borrowings, 11. So 11,000 lakhs is what I need to take. And 11,000 into 2 is 2 times. 2 times the paid up capital. What is the paid up capital? 25,000. The total borrowing is just 11,000 lakhs. Is this less than 2 times the paid up share capital?
No, but there's a credit also, 50 crores also.
Yes, that's what. So if you see here, 2 times the paid up share capital or 50 crores, whichever is less. Whichever is less. So 2 times the paid up share capital is 50,000 lakh. 50,000 lakh is how many crores? 500 crores. 500 crores or 50 crores, whichever is less. So obviously it is 50 crore I need to take for sure. Now let me see the borrowing. Borrowing is 110 crores. 110 crores is definitely more than 50 crore. So the second condition is not satisfied. Hence this company can never lend money to other directors under section 185. So this is how I need to check every single time our private limited company wants to give loan to anybody else. But practical scenario, the unfortunate part is they, since it's generally by the bunch of relatives starting this private company, they'll inform the auditors later, inform the accountants later, inform the company secretaries later. They'll create everything and then say you create the minutes today. Right? As we all know, that's the practical scene how it happens. But it tends to be very difficult because we as professionals should be very careful while reporting. This is how we need to see. Now in this is a very good example where 110 crore, we again get confused with the lakhs and the crores. So this is basically 500 crore or 50 crore, which is less. So you are 100% right, 50 crore I need to take. 110 crore is way more than 50 crore. So this company can never do it. Suppose, let's suppose if it was just to be 11 crore, that's it. The borrowing was just 11 crore. 11 crore compared to 50 crore, definitely is less than 50 crore. Now this company could have given a loan provided not even one, default is there during the year, not even one. There should not be any default in the repayment of the borrowing. So this guidance note goes one step ahead to tell that not only in this year, there should not be any default in the borrowing in any of the years. That is what the guidance note says. Because it's correct. Because if you see here also, no default in payment of such borrowings is subsisting. So subsisting word they have interpreted in the guidance note right from the beginning, from the inception of the loan. There cannot be even one default. If there is one default even like 2 years ago, then you cannot give a loan. To that extent they want us to be strict. If all the 3 conditions are satisfied, only then can I proceed and say okay, I can give loan to the director. So none of sections 185, none of the points will come. Does it mean there is no, you can freely give loan, or will there be any restrictions? Such a private company which has followed all the 3 conditions, does it mean that there are absolutely no restrictions, or will there be restrictions and they have to follow certain sections? Again 186, because 186 says any person. Who is that person? Not called under 185. This company only is not called under 185, so I'll have to go to 186. So 186 is actually a very, very important section. Every loan has to go through the rigors of 186. Only those companies where 186 will not apply, only for those companies 179 will come. And 179 is a very liberal section where MD only can give loan on his own, provided he's got the approval from the board. So this is one more practical example of this particular area, which is a definitely breather for a private company. Loans to directors, there is no power even for the central government to pardon any mistake, and finance companies, your company is also punishable. Right, now there was one case, I forgot the name of the case now, where they had given a loan and immediately within 2 days there was a repayment also made. Then they went and, this was again one more NFRA case, The auditor did not report this. They said at the end of the year there are no loans outstanding. It was not at the beginning. During the year they gave the loan to the director by mistake, and in 2 to 3 days they got the repayment also. Issue was closed. At the end of the year there was no loan outstanding. Should the auditor report this or not? Yes, it has to be reported. Second, is this a violation of 185 or not? Yes. Nowhere do we say that in case the inadvertence or if the loan has been squared up during that, nothing, no such wordings are there. So even if there is a, repayment of loan also, there is absolutely no reduction in any in penal provisions, which includes imprisonment as well. We will see the combined penal provisions slightly later. Now it's fine. Then one more issue had happened in one of the cases that I was handling, that it was a strange case. A private company was not supposed to give a loan because it had crossed that borrowing limit. They gave loan to a fiancé of a director. It actually happened. Fiancé of a director. And after the loan, within 2 months, they got married. Now, is this a violation or not? They had come to me for an opinion. So, what is your opinion? Is it a violation or not? So, they gave a loan to the fiancé of the director. And after 2 months, they got married. So then the auditor had raised the issue that it is a violation of 185. So the company had come to me for an opinion. It was a very interesting case. I thought I'll share you. What do you think occurred? So when should I see the relationship? At the time of the loan or before or during the course of what should it be? At the time of the loan, you are not a relative. At the time of the fiancé is not a relative as per Companies Act. So at the time of the loan, you are not a relative. But you become a spouse later. So this was an very interesting thing, and to my surprise, there are so many case laws on this. And they have clearly mentioned, MCA clarification is also there on that. They said it should only be seen on the date of the loan. So is it a point which can be misused? Unfortunately, yes. So people have done that as well. So company also probably did it. But the thing, since the auditor raised this query, it came up for an opinion whereby it, legally speaking, you can do that because it should only be at the time of giving the loan. So at the time of giving the loan, what are you? So if the manager, secretary, etc. subsequently, so this can also happen that I have given a loan to a normal manager. Tomorrow is a director. At the time of giving the loan, you are just a manager. But in 2 months, I have appointed you as a director. So all this unfortunately can be passed off. So this is the entire gamut of section with respect to section 185. In the same way, now let's come to section 186. Again, both are linked anyway. As we discussed, 185.1 is what we need to see first, then 185.2 we need to see second, then 185.3, we have seen all those things. Now coming to 186. 186 interestingly has 2 subsections. 186.1, I was talking about that. Can I do investment through various layers like this? That is exactly what happened. Can I do through various layers? So 186.1 clearly talks about layers of investment companies. Or you can do investment, can you do it through various layers of companies? And the second one was 186.2, that is about our intercorporate loans and advances. Intercorporate loans and advances. So this particular section, that is 186.1, came about because of, again, Cafe Coffee Day. The reason why I am very intrigued by this Cafe Coffee Day is when I just cleared CA and I wanted to be a teacher. Unfortunately, since I was young, nobody gave me a chance, and I did not have the money to start any office or something like that back in the day, 2012. So actually Coffee Day became my office. So if wherever I used to go there, just pick up a bottle of water and sit the entire day and work on my notes or work on the whatever it is. So it has a very, very special place in my heart, and it actually pains me to see that it has been dissected to such an extent. It is true, because whatever was done was really bad, unfortunately. But I have a very soft corner for this particular Cafe Coffee Day, and unfortunately now you won't even see so many coffee days that used to be there back in the day. But somewhere or the other, Vijay Siddhartha created a wonderful, brand in itself, where you could just go there and sit the full day. Just buy one coffee. Actually, you're paying not for the coffee, but for the rent. So you pay an overpriced coffee, you can pick up and sit the full day. At that time, there was no WeWork or anything charging 5,000, 10,000 rupees per month. With just a simple bottle of water of 25 rupees, you could actually manage to sit the entire day. That is what people like Vijay Siddhartha actually did for the community. Whatever is bad side, let's ignore for a moment, but at least he gave employment to, Coffee Day was one of the companies which gave employment to the differently abled people as well. You may have seen people who are blind, deaf, dumb, who are working in Coffee Day. He was the one who actually gave employment also. To that extent, he really was a good entrepreneur. However, what is bad. So where this layers of investment came was, I mean, I'll not go into the entire modus operandi of the initial NFRA case. Cafe Coffee Day, through various layers of investment back in the day, this was again 10 years ago, had transferred 20 crore to one company called Soul Space, which happened to be the daughter of our present Deputy Chief Minister. So this entire layers they had created a various layers like this. Then this was one of the practical cases. Then one more practical case was, you may have remember, those of you like IPL, there was a team called Kochi Tuskers. Remember Kochi Tuskers it's the Kerala team. So it was started by a company called Rendezvous Sports Private Limited. So Dr. Sunanda Pushkar happened to be the director there and getting millions of dollars in salary. So when this somehow was picked up for investigation, political reasons, let's not get into that. So then they realized that it actually belonged to Dr. Shashi Tharoor, was the allegation. It belonged to Dr. Shashi Tharoor, and because of which Dr. Sunanda Pushkar is getting kickbacks, and Sunanda Pushkar was the wife of Shashi Tharoor at that time. They realized there was an investigation into it in between Rendezvous Sports Private Limited and Dr. Sunanda Pushkar, Dr. Shashi Tharoor. There was, even till today, it is not clarified. Apparently, there were 400 companies through complex layering, with holding subsidiary relationship, investment companies, many sham companies were floated, and the money was routed from this company via investments to various network like that. And again, apparently it reached Dr. Shashi Tharoor. That is what the allegations were. The only person who knew about this was Dr. Sunanda Pushkar, who was found dead / committed suicide, whatever it was. But ultimately, then he got a clean chit. But I'm just saying the allegation. So this was one of the reasons why, which prompted the MCA to change the law. So the two things changed in 2017 actually. One was subsidiary company 2 clause 87 was amended to say one holding company can have maximum 2 subsidiaries. That's it. That is from 2019 onwards. 2019 onwards, one company can only have 2 subsidiaries. But what about the companies who have a lot of subsidiaries already? That portion is grandfathered. You can ignore that. But a brand new company, if you are opening now, or existing companies already have so many subsidiaries, you cannot have. This is only for vertical layer. Vertical layer maximum you can have 2. And one more interesting change was under section 186, where they said if you are one company which is there, it can be investment or any company. Company A and company B, if it is there, investment if you have to do between these 2 companies, and if you have opened investment companies to do that, maximum can be 2 layers. So between source company and the destination company, maximum 2 layers can be there. That's it. So that was the beauty of 186. A company cannot directly or indirectly invest in the company B not more than through not more than 2 layers. They use the word through not more than 2 layers. And again, these layers are only vertical integration. So can I have a company like this, one holding company? Can it have around 10 subsidiaries? Yes. Horizontal integration, no problem. The problem was vertical integration. Vertically, you cannot have more than 2. So 2 landmark changes came. One was 186.1. That is what we are discussing here. 186.1, layers of investment company. So one company can invest in the final company not more than 2 investment companies. That investment company could be an investment subsidiary also, is what they said. On the other hand, if I am a holding company, I can only have 2 subsidiaries. That's it, 2 layers of subsidiaries. But if I am investing, one company is investing in the second company, they have used the word through, which means investment company 1, investment company 2, and there ends the matter. So there are many rules regarding that. That is regarding 186.1. So let's not discuss further on this. This much is more than sufficient. So this is regarding layers of investment company. But now coming to our discussion, 186.2. intercorporate loans and advances. Intercorporate loans and advances. So we have been discussing before, wherever 185 will not come, it will come under 186. So again they say no company can directly or indirectly invest. That's a common language that they use. So I can just, once again, I'll just come to 186. No company can directly or indirectly. So that's the word used here, directly or indirectly. So now my question here is, what do you mean by indirect? It says, see, basically it talks about giving the loan, giving a guarantee, or even acquiring securities, acquiring a subscription of securities. My question is, sir, directly or indirectly? What according to you will be indirect? So no company shall directly or indirectly give any loan to any person, give any guarantee or provide any security to any person, or acquire by way of subscription, purchase or otherwise securities of any other body. This is fine. But no company shall directly give loan to any person, okay, provided you follow the conditions. No company shall indirectly give any loan to any person. What do we mean by indirectly giving? This was actually not defined anywhere. Indirectly was not defined anywhere. So because of that Shashi Tharoor thing that happened, one more change came. One was in 2 clause 87, one more was 186. Third change came in chapter, which is in your section 89 and 90, and they spoke about significant beneficial ownership, SBO, significant beneficial ownership. So they said, if there is a person who has beneficial ownership of shares, for example, in Rendezvous Sports Private Limited, the actual shareholder was Dr. Sunanda Pushkar, but the beneficial owner was actually Dr. Shashi Tharoor. If I have to take that example, the beneficial owner was Dr. Shashi Tharoor. Similarly, in this recent case also, it goes without saying that the shareholder was VG Siddhartha's father, but the beneficiary of that entire shareholding, as proven now, happened to be Mr. VG Siddhartha. Right? It's very, very clear. Beneficial interest is what I need to see. So that concept came about again in 2019. They spoke about something called SBO. So what is SBO? Significant beneficial ownership. 3 checks an auditor has to do. First check, SBO should be a natural person. So in our case, VG Siddhartha should be a natural person. Let's assume that he was alive. So yes, VG Siddhartha should be a natural person. Yes, that is checked now. Second check, such person holds at least 10% of shares or voting right or dividend along with direct or indirect put together. Directly he may not hold even 1 share, but indirectly is he holding? Yes. Through the relatives here, because relatives are anyway covered in indirect. So yes, is he holding indirectly? Yes. Third check, even if direct control is not there, I don't care, there has to be some indirect holding. Through the relatives, I now have indirect holding. So if all the 3 conditions are satisfied, as per section 90, VG Siddhartha has to send a notice to both the companies, that is MACEL and CDEL, telling that I am a significant beneficial owner. Which all companies have significant beneficial ownership, that has to be clearly mandated. Not only that, even CDEL has to enquire which are the companies in which VG Siddhartha is significant beneficial owner. MACEL also has to enquire which is the company in which all the directors are significant beneficial owners, or is there any other significant beneficial owner for this company. So this was not mandated at all till 2019. In 2019, they added that provision saying that onus is now on director, onus is now on the company also. Then what should the auditor do? He has to check this and take a management representation letter. And unfortunately, this also was not done. So when they were checking the, since all loans were went to Mysore Amalgamated Coffee Estate Limited, auditors had to check the, recoverability. Is it possible to recover from that? A recoverability certificate had to be taken. And shockingly, even though VG Siddhartha was not even the director of that company, they closed the entire issue by just taking the net worth certificate of VG Siddhartha. Imagine, I need to check the, borrower's credibility, but I am checking the lender's net worth certificate and then closing the entire issue. These lapses are shocking. And that is the entire report that, I'm just telling you, shocking lapses. So if I have to go for the credibility test, I need to check the borrower's credibility check, not the lender's credibility check. So here they entire closed the issue by taking that one particular thing, and that was about it. That's about it. So coming back to this significant beneficial, again there's an entire definition of SBO. So you should have more than 50% share in a body corporate, they say, and if that body corporate holds 10% in the reporting company, then you are an SBO. That is one route of it. There are many routes, and this diagram will help us understand. So that's the meaning of directly or indirectly by reading with section 90. So whenever we are doing the audit to check 186, as per the guidance note, they clearly mention kindly check 89 and 90 also and take the relevant documents. So SBO, if I have more than 50% in a body corporate and that body corporate is having more than 10% in the reporting company, then that Mr. A is called as an SBO. On the other hand, body corporate happens to be a partner in the partnership firm. Partnership firm is holding shares through the body corporate, there is one more issue. Or the SBO himself, Mr. A is a partner in a partnership firm. Partnership firm is holding in the reporting company, that also is covered. Then SBO, that is Mr. A, is a karta of HF. HF is holding in the reporting company more than 10%, more than or equal to 10%. Or SBO himself through a trust is holding more than 10%. Anything for that matter, it will be a significant beneficial ownership, and the onus is on both the company as well as the significant beneficial owner to disclose. That was a major change, and that is the actual meaning of directly or indirectly as given in section 186. So that's about it. Now coming to the actual section 186. So in 186, who all are covered? Both private company and public company are covered. Unlike exemption given for private company in 185, no exemptions given for private company in 186. All private companies have to mandatorily follow section 186. So in 185, if it is not applicable, automatically it will come under 186. So those companies which are enjoying exemption under 185, that private company example that we discussed, those companies for all loans have to follow 186. So what all is covered? Same thing, loan, guarantee, security. Then one extra thing is there, that is securities of a body, investment in the securities of a body corporate. So again here, loan is given to whom? Loan is given to a body corporate and loan is given to any other person. It is intercorporate loans. It used to be intercorporate loans only before, but now with the addition of the word person, it is also means loan given to anybody else other than 185. If it loan is given to a trust, it is covered here. Loan is given to HUF, it is covered here. Loan is given to any other individual, it is covered here. Then was an important question. What about loan given to employees? Loan given to employees. 185 or 186? 185 will not come because I am not a director. Loan given by company to employees of the company, which you will see in a lot of private companies. What should we follow? 186? 185 anyway will not come. 186 or that residuary section 179. 186 or 179? It used to be 186. Then they inserted an explanation in 2017. They said person does not include individual who is in the employment of the company. So they inserted this amendment in 2017. So to basically employees are not covered. Employees is an example which is now covered under 179. 179. So the board can authorize through a board resolution to the managing director, and managing director himself can start granting loans on behalf of the company to all the employees. Every employee, if I have to give a loan, I don't have to go take a board resolution. One board resolution sanctioning him to give a loan per employee, such some capital, some cap you can give, and then that person, the MD himself can pass. It is very much possible in law. It is valid. It's valid. On the other hand, it says investment in the securities of a body corporate. Now this is what the law says. If all these things, loan, guarantee, security investment, whatever you are doing, up to 60% of paid up share capital, again, free reserves, security premium account, all three put together, which is nothing but, if you think about it in layman's terms, net worth. 60% of paid up share capital, free reserve, security premium account, or 100% of free reserve, security premium account, whichever is higher. So whatever loan, guarantee, security investment that you are making, if it is up to 60% or 100%, 100% of simply FR and SP, free reserve and security premium, 60% of paid up capital, free reserve or security, that is a net worth. If you do up to 60% of the same, if you do up to 60%, battery is on.
Correct.
So, right. So up to 60% of paid up share capital, free reserve, security premium account, or 100% of free reserve and security premium account, whichever is higher, then I would require a board meeting resolution. And if it is beyond that, then I would require a special resolution plus board meeting resolution. Otherwise, any loan given, guarantee, security investment would be void ab initio. We'll take an example to understand that. One interesting part, again, private company, public company, it is already done, no change. We have discussed what is a loan already. Guarantee we have discussed, security we have discussed. Body corporate can be anything whatsoever. Those which are not covered in body corporate, for example, trust is not covered in body corporate, that will be covered under the definition of person. So absolutely, the only thing that is excluded in the definition of person is employee. Employee is not covered. Now, if I am investing in the capital of, company is investing in the capital of a partnership firm, assume, or company is investing in a trust. Company is investing in a trust. Will it come under 186? The company, as part of CSR activities, wants to invest in a trust, and the trust is then doing it. It can either be a Section 8 company or through a trust. So, a company, as part of CSR activity, is investing in a trust, which in turn is doing all the CSR activity. So, when I am investing it in the trust, should I follow 186? No, because it is investment in the securities of a body corporate. Investment in the securities of a body corporate. It's very, very clear. Investment in the securities of a body corporate. Securities will be as per Security Contract Regulation Act. Everything is covered there. Your equity shares, preference shares, convertible debentures, mutual fund units, ADR, GDR, IDR, whatever you want. Everything is, even the security receipts as per SARFAESI Act. Everything is covered under securities. Body corporate, again, the same thing. Now, if I were to invest in some shares abroad, I am purchasing some shares of a foreign company abroad after following the RBI and FEMA regulations, would that come under 186? Some practical points, yeah. What do you think? Will it come under 186? Yes. Why? Body corporate. Body corporate includes foreign company. Body corporate includes foreign company, and securities will include everything. Securities will include absolutely everything. Now, if I am investing in certain units of mutual fund, which is, let's say, Kotari Mutual Fund, but Kotari Mutual Fund, the base is not a company, but it is a trust. Because mutual fund, generally it is a company, but it can run as a trust also. So, if I am investing in mutual fund units of Kotari Mutual Fund, which is actually run as a private trust, so that, what do you think? Will it come under 186 or 179? 179, because again it is not a body corporate. Kothari Mutual Fund, which is registered as a trust, is not a body corporate. Just some examples. Ultimately, I mean, all mutual fund houses, as per SEBI regulation, now it has to be like a company, etc. But I'm just saying, in case any such thing that comes to you, that there is a private trust that they have run and they are investing some money into that private trust, which is run not as a company but is running as a trust, 186 will not come, 179 will come, right? So that is the meaning of investment in the securities of body corporate. For whatever reason, whether it is up to 60% or 100%, whatever reason, one resolution is mandatory. That is board resolution. Board resolution is mandatory. And in one of the coffee day cases, they had taken a circular resolution. Is that valid board resolution or not? Board resolutions are of two types. One is called board meeting resolution, where we discuss across the table and then pass a resolution. One more is circular resolution, granted legality under 175 of the Companies Act, whereby the draft resolution along with the necessary documents will be sent to each and every director on his email ID. He will sit, understand, and then pass the vote without any discussion. So my question is, can I pass this if I am giving a loan guarantee, whatever, up to 60%? Can I do it through a circular resolution, or should it be at the meeting of the board itself? Yes, it's very, very clear. The laws talks about the subsection 5 clearly talks about meeting of the board. It can never be circular resolution. Any circular resolution passed will be void ab initio. Then another interesting area, this has to be read with 184, but I'll ignore that for the time being. Another interesting area is, there are, let's say there were just 8 directors in the company, and this was a matter of section 186, and 6 people actually came for the meeting, and 4 people said yes to the resolution, and 2 people abstained from voting. They did not say no, mind you, they abstained from voting. So out of 8 directors, the directors who came for the meeting are 6, of which 4 passed the resolution. 2 said, I'll abstain from voting, I don't want to vote on this resolution for whatever reason. That's their right. They did not say no though, but they abstained from voting. Is the resolution valid?
Chairman's casting vote will be there.
Casting vote is not needed here because it's already passed, right? 4.
Quorum.
Yeah. So its quorum is also present, 6 directors quorum. Quorum is present. 4 already said yes, just 2 said no. Is this resolution under 186 valid?
So for this, they think unanimous is required.
Yes, sir. So, as sir said, for this unanimous is required. My next question is, unanimous resolution is a resolution where even one person says no, is that the case, or even if 2 people abstain, is it a no? In a unanimous resolution, should all the people attending the meeting say yes? Or even if 2 people have abstained, is it still a yes? All the directors attending the meeting should say yes, or nobody should say no. What do you mean by unanimous resolution?
Nobody should say.
Nobody should say no. Again, we have to see the wordings. Is it without any vote being cast against it?
All the attending.
Or is it all the directors should vote yes? That is, both are different. Is it without any vote being cast against it? The resolution is said to be passed if they get vote without even one vote being cast against it. If that be the case, if 2 people abstain, it is still valid, because I have not said no to it. On the other hand, if I say all the directors who attend the meeting should say yes, which means even people who abstain, it will be a no. These were again issues raised in those reports, unfortunately not checked. And shockingly, our institute has removed law from CA final. I need to bring this here to the notice, whether you know it or not, I am not sure. Company law has been removed from CA final syllabus. Shocking decision by ICAI. So as of today, the new brand of chartered accountant students will never study company law. It is there as part of a self-paced online module, which is a time pass examination, which they read 40 questions and go and write and pass that examination. It's a time pass exam without any negative marking. So the crux of the NFRA findings was the lack of knowledge of company law among the chartered accountants of Big 4, and that who had subject called company law in their syllabus. And I just fear for the current crop of CA students, who have no idea what is coming for them in the future. It's very sad, unfortunate. I have no idea who will be powers that be who took this decision. I'm not saying because I'm a company law faculty, I am also a direct tax faculty. For me it doesn't matter, and even for you it doesn't matter because all of us have the knowledge. But think about the future of our profession if the syllabus itself is not attuned to the current trends in the market. So to coming back to this question, so if you see, as you rightly said all of you, consent of all the directors present at the meeting, which means 6 out of 6 should say yes. Even if 2 of them say I don't want to vote only, it is deemed to be no. That is how, what do you say, tricky this section is. That is the rigor of the restriction that this section puts. You need to take all the approval of everyone. It is very, very clear. If I go beyond that, apart from the unanimous resolution, I also need to take the special resolution. 75% of the shareholders, 75% majority, not the number but the value, 75%, they have to say that okay, no problem, this is correct, let's go ahead with it. So this is the entire section. I mean, that's the overall structure. Loan, guarantee, security, investment in the security of body corporate and all those things. So coming to free reserves. So here we have free reserves, security premium account, paid up capital. When should I see this? Date of the investment or date of giving the loan, or again latest audited balance sheet? Actually they have not given anything, but if I see the definition of free reserves, it says latest audited balance sheet. And the guidance note they have given, thankfully, they have told all these 3 things should be seen on the date of the latest audited balance sheet. Latest audited balance sheet. So in case any loan is being given on 1st April, the latest audited balance sheet will not be 31st March the previous day. It will be the previous year. That is one more thing that we need to see. This also was one of the points in one of the cases. 2nd April they gave a loan, but they didn't check on 31st March of that year. They checked 31st March of that year. But they should check the previous year because the wordings are LABS, latest audited balance sheet. If it is not audited, they never say year end, they say latest audited balance sheet. That is one more point. So what are free reserves? It will include all these things, any wordings that profit and loss account, general reserve, dividend equalization, whatever name called, and even this has been added. Free reserves and security premium account. Technically, security premium account, as you know, is not a free reserve, but for this section they have added, merged everything. What is not free reserve? Some of the examples based on decided case laws are capital redemption reserve, sinking fund, provision for taxation, fixed assets revaluation reserve, capital reserve, share application money obviously will not form part of your free reserves. So I need to check the paid up capital, free reserves and security premium account all together. So one thing is that, for example, how do I do the calculation is, first of all,
would be part of free reserve.
sorry sir?
Share warrant
Share warrant?
would not be part of free reserve.
Yes sir, yes sir. Correct, you're right. Share warrant also we can add here. It will not be part of free reserves. These things are free reserves. Thank you for that sir. You're right. So next, how would we do it practically is, basically I need to first calculate the limits. 60% or 100% of the limits is what I need to always calculate in any balance sheet. Or at the time, the latest audited balance sheet I can take, that is the auditor's point that I have to do. Then, point number B, let's say this comes to, just for argument's sake, around 20 crore. So if I do 60% of net worth or 100% of FR and SP, whichever is higher, I'll get 20 crore. Point number B, I should actually take into account the loans, guarantee, security, investment which has already been made. That is what the law says. It never says only what you are making now. Whatever you have made also you have to take into account. That is all the loans given, guarantees given, securities given, investment made, already made. Everything you should take into account. Let us say that is for that year. Let's say that's coming up to around 12 crore. C, point number C is the whatever I can still make now. Whatever can be made. So can be made obviously will be step number A minus step number B. So this comes around 8th year. So what loan guarantee security, which is the calculation 20 crore I need to make. Then loan guarantee security investment already made is 12 crore. This is given in the guidance note actually. Then whatever can be made is 8 crore. We still have that 8 crore balance. Then point number D is where I need to see the actual proposal as of today. So as of today, when there is a proposal whereby it says that you are going to make a loan guarantee security investment of, let's say, let us say around 6 crore. Is it well within the limit? Yes. Since it's well within the limit of 60 or 100%, for this particular thing, I would just need a board meeting resolution and it has to be unanimous. It has to be unanimous. On the other hand, if it was not 6 crore, it is 9 crore, then I would need a special resolution also. But things will get interesting if I have borrowed from a public financial institution. If I have borrowed money from public financial institution, that company, can the company actually give loan guarantee security investment? That's the next question. What am I doing? I am taking from somebody and then giving it as a loan. So that will it be allowed or not was one more question raised. So for that I have this particular chart which becomes easy. So they are saying that the limits can be anything for that matter. I'll give the full thing. The limits, that is what? LGSI limits, that is to be made and already made, whatever, it is 60 or 100% here. Have I made any default in the loan taken from PFI? Means, have I paid that or not? If I have made a default, assuming it's less than 60 or 100%, if I have made a default, then they are saying that you should take the approval of the PFI also. Prior PFI approval is needed. So in case a company in which you are auditing, let's say it's a private company, has taken a loan from a public financial institution, and unfortunately they have made a default one of those installments, then or whatever reason, even for COVID for that matter, whatever reason, even once in their lifetime, in the lifetime of the loan, if they have made a default, you have to take prior approval before giving 1 rupee also as loan guarantee security investment. Even if you have to invest the funds and if there is a default, you have to take the approval, plus board meeting resolution, plus unanimous. When will you not be, when is it not needed to take approval? When whatever you are giving, loan guarantee security investment, what you are giving is less than, that is step number D in the previous slide. Step number D, that 6 crore example, 6 crore is less than 8 crore. Then there is no default also. Both the conditions should be satisfied. First of all, it should be less than 60%. No default. Only then, only one scenario, there is no PFI approval, board meeting resolution plus unanimous. In case you are giving more than that 60 or 100%, in our case that step number C was 8 crore, but my loan that I am giving now is 9 crore, assume. In both the cases, whether there is default or not, I don't care, this is immaterial. The moment it crosses 60 or 100%, I have to take a PFI approval. I have to take a PFI approval. So the relaxation from PFI approval is only one case. The step number D that I am doing, the proposal analysis, that should be less than, the proposal analysis that I am doing should be less than what? 60 or 100%. And there should not be any default from a PFI. Should not be any default from the loan taken from PFI. Only then there is no PFI approval. In all the three cases, I would require a prior PFI approval. So, as a statutory auditor, we need to check if the company has taken prior PFI approval. This is the guidance note says so. Prior special resolution, board meeting resolution, unanimous approval, and of course we need to see the logical conclusion whether NGT 14 was filed. If that is not filed, the loop is not closed. That is the reason all these things should be checked as a statutory auditor. You can of course check it whether the company has done or not. Again, this is talking purely from the guidance note point of view. Yes, so guidance note is very elaborate, almost I think 200-250 pages, very elaborate guidance note on the audit of 185. CARO basically, in that especially these points, excellently the institute has covered to be fair to them and to appreciate their work. So indirectly we have already seen. Now next question is again valid question. What about intercorporate debentures? Intercorporate debentures, are they securities? Debenture is definitely a security. Are they securities or are they loans?
Your loans.
Loans or securities? So this again went to MCA. They said intercorporate debentures are not to be considered as loans. But if I have invested in the debentures of one more company, it will come in that point. Investment in the securities of a body corporate. So anyway, under that it will be covered. But is it a loan as such? No. Then one more question. What about intercorporate deposits? I think one of the gentlemen today had taken deposits in the morning, right? So what intercorporate deposits? Is that a loan? This was also a valid question because many companies do these deposits, intercorporate deposits, they'll deposit, make a deposit in the other company. So would that be treated as a loan?
No.
Would that be treated as a loan? No. Okay. Then in that case, what is it then? Will it come under 186 or no? If I invest in the deposits of some other company, will it come under 186? It's not security. Is it a security? No. Right? So if you see, intercorporate deposits are not deposits as per Rule 216 of Companies Acceptance of Deposit Rules. So intercorporate deposits are not deposits at all. They are not deposits at all. But if you see the definition of deposit, you see the definition of deposit in the Companies Act, it says deposit includes any money taken as a loan also. Right? So because of that reason only, in section 2 only it defines clearly. Because of that, it should be entered in the calculation as per guidance note. It should be entered in the calculation of 60% and 100% limits, but as a loan, not as a deposit. Intercorporate deposits are not deposits itself, as per the Rule 216. But if you see the definition of deposit in Companies Act, it says deposit includes any loan. Since it says deposit includes any loan, deposit should be treated as a loan for the purpose of 60 to 100%. Otherwise, again, it would lead to a lapse in professional judgment. This is again guidance note point. So we should kindly note that intercorporate deposit should be entered in the calculation as a loan and not as a deposit. On the other hand, what about intercorporate advances for supply of goods? Are they loans? One company gives an advance to the other company for supply of goods. Would that be a loan as such? No. Then again, we should see one thing. If the advances are not set off within 365 days, it will be treated as a deposit. And since it becomes a deposit, it becomes a loan. So the next interesting part is corporate advances are genuinely given for the purpose of trade, etc. should not be bracketed as loans under 186 provided it's set off within 365 days. Again, wordings from the guidance note. So if we have to see whether 365 days, if it is not squared off, then only then it will be treated as a deposit. The moment it becomes a deposit, obviously it will become a loan. ABCD, we have already seen that 4 points. Now I had asked the question in 185 about holding subsidiary relationship. So whether it would be 185 will come or not. On similar lines here, if a holding company gives a loan to a joint venture and the holding company gives a loan to wholly owned subsidiary, as we have seen, 185 will never come. We have seen this very clearly. 185 will not come. Will 186 come or not? Here they say 186 also will not come. Which means, if a holding company is giving loan to a wholly owned subsidiary, the only thing they have to follow is a simple board resolution. No need of board meeting resolution, no need of unanimous resolution. In a simple board resolution, you can just give loan to anybody, no problem. So, provided it's a wholly owned subsidiary. So that was what was actually there before. But again, 2017 Amendment Act changed everything in a very simple sense. They have told one thing now. They said definitely, I'll just put the entire thing, it will be easier. Yes, they have told in this particular two things that no, 186 will still apply. Only thing that will not apply is special resolution. Only thing that will not apply is special resolution. So, to refresh, if a holding company is giving a loan to a wholly owned subsidiary, 186 will definitely apply. This generally we will not check, which means board meeting resolution will apply, unanimous resolution will apply, but if you are crossing the 60% limit, special resolution will not come. That is the only thing which is exempt. So it is added as a proviso to the subsection which speaks about special resolution. It says provided if a holding company is giving loan to wholly owned subsidiary, provisions of subsection, provision of that special resolution will not apply. That's it. So these two will definitely apply even if a holding company is giving loan to wholly owned subsidiary. Similarly, if holding company is giving guarantee or security to anybody who is investing in, who's giving the loan to a JV or a wholly owned subsidiary, then again special resolution alone is exempt. Special resolution alone is exempt, other things are not exempt. If a holding company is investing in the securities of a wholly owned subsidiary, then also special resolution is exempt. The only thing where the full 186 will apply, full 186, 185 will not apply in this case, but full 186 will apply will be holding company giving guarantee or security to a bank or financial institution, which in turn is giving a loan to a subsidiary company. Holding company giving guarantee or security to a bank or financial institution, which is in turn giving a loan to a subsidiary company. In this case, full 186 will apply. The entire 186 will apply. So practically speaking, in this particular case, this is what happened. So CDEL, that is the Coffee Day, had invested 2,749 crore of shares in Mindtree. Then VG Siddhartha personally had invested 519.81 crore worth of shares in Mindtree. And this Mindtree shares were pledged with the lenders because they were not paying back. So the beauty is the subsidiary company borrowed a loan from Standard Chartered Bank to the tune of 2,960 crores, of which 789 crores was given as a loan to MACL. The remaining 2172 crore was given to CDEL. Subsidiary company gave a loan to the holding company to recover the money, to ensure that whatever is pledged with the lenders the pledge can be cancelled. So that is what happened. There is a reverse case, subsidiary company giving a loan to a holding company. That is like any company giving share to any company, there is no exemption, 186 will apply. In this case also, violation of 186 happened, and this was again a holding company giving shares to one more subsidiary company, that is 789 crore. For that also 186 was, the special resolution point was not at all covered because the loan, the paid up capital reserves etc. was just around 78 crores. They were giving almost 10 times the loan amount. Still, absolutely no provisions were taken into account. So these were the practical stuff in all these areas. Now, one more thing is, in which cases will section 186 not apply at all? One we saw employees. Next part, which cases would this section will not apply at all, where you don't have to do anything. One is, of course, if you are an investment company, insurance company, housing finance company, that's okay. And if you are giving loan, no problem. One interesting thing is, which happened in 2020, let us say you are Infosys or you are any random company, or your company in which you are doing the audit, they have invested in some shares held by Reliance. So when they were investing in shares held by Reliance, let's say they have already invested in shares held by Reliance, fair enough. When they were investing in shares held by Reliance, should you take the approval? Yes, approvals have to be taken. So if your company in which you are doing the audit, let's say a private company, is investing in shares of Reliance. Let's say you wanted to invest around 30 lakhs. So should you take all the approvals? Yes, goes without saying, you have to take all the approvals. In 2020, an interesting thing happened where Reliance issued right shares. When they issued right shares, they said for every 15 shares held by you, you will get 1 share. These were the terms of the offer. And I think if I am not wrong, the market price of the shares was around 1,600 odd. They said that at 1,300 rupees you will be getting if you exercise the right. This company now wants to invest again in the right shares issued by Reliance. And in that regard, let us say they have invested by paying 10 lakh rupees. So tomorrow, when your company is investing in the right shares issued by the company which you have already invested in, the question which was raised to the MCA was, should I take the approvals of 186 again? Should I take approvals of 186 again? Board meeting resolution, unanimous approval, and if need be, special resolution, what should I do? Like when I do that ABCD, LGSI already made, to be made, so should I take this into consideration? So it's a very hidden point in the law. 186(11) says nothing contained in this section, nothing contained in this section shall apply to any investment made under 62(1), that is right shares. So if I am making investment in right shares, the entire section 186 will not come, because this right shares is a benefit to the company. Since it's a benefit to the company, 186 need not be followed. A simple resolution under 179 will be enough. A simple resolution under 179. Can it be delegated to managing director? Yes. Managing director himself, if he has the power, can invest in Reliance right shares, because again these things will take time, right? Right shares will only be for 15 to 30 days, and if you sit and pass board meeting resolution, then special resolution giving the notice, that's the reason, a very valid point, no need to do it. Now an interesting question, in the next year, when I am calculating loan guarantee security investment already made, I have to calculate that already made. That already made will be, will I take 30 lakhs or will I take 40 lakhs?
40.
To calculate the limits. Should I take 30 lakhs or 40 lakhs? Next year when I am calculating loan guarantee security investment already made, should I take 30 lakhs or 40 lakhs?
40.
Again this went to the court, and the court interpreted this one line. Nothing contained in this section. It is not notwithstanding anything contained. Notwithstanding is a non-obstant clause, only the conflicting provisions will be overridden. Here there is no conflict, everything will be overridden. So, which means once exempt, always exempt. So once I invest that 20 lakhs in the whatever shares, tomorrow should I take that into consideration? No. This 10 lakh, it's as if I have never invested. So tomorrow's limits, loan guarantee security already made, I should take only 30 lakhs and not 40 lakhs. That is again a clarification clearly mentioned in the guidance note as well. They have told that any right shares follow the rule, once exempt, always exempt. Once exempt, always exempt. So to summarize the portion before we stop in the session. So a couple of things. Before that, one more thing. This was again a practical case. Issue went to court. I'll just make a very easy summary of it. If there is a company Y Limited, the share capital of 100 lakh, free reserves of 100 lakh, and let's say unsecured creditors of 30 lakh. Y Limited is giving a loan to X Limited. Again, I should do the same thing. 60% of free reserves and share capital, that is 200 lakh, or 100% of free reserves, whichever is high, right? Which will give me this logic, 60% of 200 lakh, that is 120 lakh, or 100% of 100 lakh, is 100 lakh, whichever is high. So which means that if I have to give a loan guarantee security investment overall, already made plus to be made, if it is up to 120 lakh, board meeting resolution. If it is more than 120 lakh, then it requires special resolution. That's fine. Beyond 120 lakh would require special resolution. The proposed loans already given plus the proposed loan to be given, all put together is now becoming 210 lakhs. 210 lakhs. Special resolution is passed by the company. Is it valid or not? Special resolution is passed. As we discussed, up to 120, no special resolution. Beyond 120, special resolution. In this case, it's 210 lakhs, obviously beyond 120 lakhs. Company, it was a practical case that happened. The company passed a special resolution. Is it valid or not? So in this particular thing, they came out with the MCA came out with the guidelines saying that if you are agreeing for giving a loan of 210 lakhs, you please see what is your funds. Your funding is only 200 lakhs. Shareholders' funds is just 200 lakhs. Which means if you are passing a special resolution, you are agreeing on behalf of unsecured creditors to use their money to give loan. That was a logic by MCA, very good logic. They are saying now as of now it's 200 lakhs. That's your shareholders' funds. If you say 210 lakhs I can give, I am actually giving 10 lakhs from the unsecured creditors. You have no right to do so. So MCA said it is not written in the law, but it is understood. You should have known the highest limit that you can go through is what? Is your net worth. Beyond the net worth, you cannot give any loan guarantee security. One of the most amazing clarifications issued in 1976, if I am not wrong, right? Because of a case that came there. So it is not in the law. They are telling it need not be in the law, it's understood. It is understood that you as a shareholder, your power is only till the net worth. How can you approve more than your net worth? That is somebody else's money you are approving, not alone. So to summarize the loans to directors concept, I'll use this chart which will help us. So if my lending limits, that is loan, guarantee, security, investment, already made and to be made. If it is up to 60% of paid up share capital plus free reserves plus security premium account, or 100% of free reserves and security premium account, whichever is higher, I would need board meeting resolution, which has to be unanimous, and prior PFI approval wherever needed if there is no default. However, if it is more than 60% of the same or 100% of FRNSP, whichever is higher, or up to the net worth, very important, up to the net worth only now, prior PFI approval, whether there is default or no default, prior special resolution and board meeting resolution, unanimous approval and MGT 14. On the other hand, if I were to pass anything which is more than the net worth, it is ultra vires the Companies Act. It's any resolution which is going beyond this will not be possible at all. One more practical question the CAs raised this, sir, they are investing in a lot of funds in the company. They have invested the funds in securities. They have bought 100 shares of Infosys, 200 equity shares of Reliance, 300 preference shares of Wipro. So they asked a valid question which is answered in the guidance note. Should they pass separate special resolution for each of the companies that they are investing in, or should they pass separate special resolution for the instruments like 100 equity shares of Infosys, one special resolution, 100 preference shares of Wipro, one special resolution? Is it like that? Question was raised by a CA to MCA and also to the ICAI. Guidance note gave the answer. What do you think? Is it investment by separate special resolution? For example, there are two things. Should I pass a special resolution saying that I am investing in 500 shares, one special resolution? Second special resolution, 500 shares will be 100 equity shares, 100 preference shares and something. Company wise, investment wise, should I pass special resolution separately or overall investment? Blanket investment. These things are not there in the law. We have to go to the guidance note. Guidance note says it is, whether we like it or not, it is company wise, investment wise, separate special resolutions have to be followed. Because it's like the shareholders may agree to invest in 500 shares, but have they agreed for the breakup of that 500? Is it 200 equity, 300 preference? And even if they have agreed on the breakup, are they okay with 100 of that in Reliance, 50 of that in Infosys? So this is the level with which we have to take the resolutions. Company has to follow, for which the company secretary is there. But the auditors on the other side should understand that these are the special resolutions that have been taken. Tomorrow, if any issue comes up and these documents are missing in our working papers, then the same fate, unfortunately, will befall us as well. So with this deemed dividend will become too much. So quickly, I'll just see few pointers. I'll give you the Caro points as well. I'll just take 3-4 minutes. Caro points is the reporting point. One is we have our 143(1)A, which says that whether loans and advances made by the company have been properly secured, so that we need to check. And this is the guidance note important points. The loans during the financial year under audit, even whether outstanding or not, I need to check. And they have clearly mentioned you should make a difference between deposits and loans and advances. Whatever security you have taken, you need to say there's movable, immovable. So these are the documents that you have to verify. I will give you this document, we can check that. And then disclosure and reporting under 134(3)G, that is form number MVP2 has to be filled up and released by the company. This is how it looks at. That is all the guarantee and security made by the company. And Caro 2020 some additions, whether during the year the company has provided loans or provided advances in the nature of loans, they say, for stood guarantee, whatever it is, this clause 3 says aggregate amount during the year and balance outstanding at the balance sheet with respect to all these things. Not just to that company, but also to subsidiary, joint venture, associate, everything we should report. And also this format is what they have suggested as per Caro 2020. Guarantees, securities, loans, advances in the nature of loans, aggregate amount granted during the year, and all these subsidiaries separately have to give, and the balance outstanding as on the balance sheet date also has to be given. Apart from that, if any loan has been renewed or extended, for example restructuring, Loan restructuring they have done, interest you have not paid, so they have given a fresh loan. That also has to be taken as a fresh loan obviously because you have not repaid the loan. So that also is given in the CARO 2020, it's an addition. In a similar way, repayable on demand, agreement does not specify the terms. What is the percentage of loans which is in the nature of total loans? There is a suggested format that they have given. We can go through this later, and they have segregated between all parties, promoters and related parties. If we had done 188 also, we would have linked that here. Loans granted and renewed during the year, irrespective of which the period to which the loan relates, everything has to be mentioned. Even if it's a 3-year-old loan, I have to mention it. Even if there is a one installment lapse 2 years ago, and if the previous auditor had not done it, we have to do it. And they have clearly mentioned get acquainted with 184, 188, 189. When I say loans, I don't care whether it is short-term loans, long-term loans, whether it is given in cash or kind, which we discussed. Everything should be verified. The actual language of the guidance note is what is there. And as I already told you, I gave the loan at the beginning of the year. At the end of the year, there nothing was outstanding, which means the loans were squared up. Should I report that as well? Yes, I should report that as well. Not just outstanding loans, but everything has to be reported. Apart from that, some important points we'll just see. Yeah, I should consider the factors like ability to lend, terms of the borrowings, which again in the forfeit case that was not done unfortunately. And audit enquiry under 143(1)A is also there. That is there a possibility of concessional rates of interest? 186 says you cannot give interest-free loans. But can you give a concessional rate of interest to employees? Yes, because employees one is not covered under 186 as we discussed. Apart from that, yes, clause 3 also talks about regularity of receipts. Then if it's overdue more than 90 days, you have to take reasonable steps. All that we have covered during our discussion, but some of the finer points are given here. That's about it. Yeah. Then lastly, last but not the least, we'll have to see the penal provisions and then we can end it. Penal provisions as per the amended law in 2020. So I have also added 184 and 188. 184 is disclosure of the director's interest and 188 is related party transactions. So technically all the 4 sections have to be done together. So in case, who is penalized in 185? Company, director, other person, whoever has received the loan, everybody. And company has to pay 5 lakh to 25 lakh, and in 186, 25,000 to 5 lakh, all that is okay. But here, this is the concerning thing. Director or officer in default, up to 6 months imprisonment, 6 months imprisonment or 5 lakh to 25 lakh rupees fine or both. So it is a compoundable offence. I can escape punishment by paying the fine by applying for compounding. But the interesting thing in 186, which was a slight change and shocking, is 25,000 to 1 lakh and up to 2 years, which means it's a non-compoundable offence. Any offence of 186 is a non-compoundable offence, which means imprisonment will come if convicted. So the case would go on. As of today, there is no such conviction as such, but yes, it can go up to 2 years going forward. And contract is not affected in these 2 cases. No proportional reduction also. Whether will it result in the disqualification and vacation of the director? No. On the other hand, if the director has not disclosed the interest, means any director should disclose the nature of his interest while taking up the contract with any other company, there will be a penalty of 1 lakh rupees. Apart from that, any related party transactions, there will be some other penalties. So 184 and 188 earlier it used to be fine. Now they have decriminalized it and made it penalty. That's why I have highlighted in yellow. Because when I said penalty, I can give it to the internal adjudicating authority, that is the ROC. Whereas if it were to be a fine, I had to go through the court mechanism. But if you see here, it's still fine, and this is the most dangerous part of 186, which is the imprisonment for the director as such. And coming to the other side for the auditor, we have already discussed all the violations which are there, the penal provisions, already the damages, and apart from that, the fees will be refunded whenever you receive it. And then apart from that, 5 times, 10 times, whatever the case may be. And unfortunately, the moment you come out of 5CA and then are happy, NFRA will be waiting. If it is a company which is a listed company. So in that sense of the term, the importance of 185 and 186 shows that because of the recent cases, it shows how important these 2 sections are. So I would thank the branch for giving me this wonderful opportunity. Despite being a post-lunch session, I would also like to thank all of you for being a very patient audience and listening with rapt attention and also participating in the quiz. Thank you so much for your time. Thanks a lot. Yes, thank you. Yes, ma'am.
Well, the subject was such that everybody had to pay attention, and thank you to you, Punarvas Jayakumar, for taking all our members in such a way. Elucidating the section in a very simple way, while it's a complex and important section. Thank you. On behalf of Bengaluru branch, we thank you for your time. I request Chairman to hand over a memento to the speaker. Can you please do that? Thank you. With this, we wrap the session seminar today. I would like to thank the venue people and for giving us this venue and making this event possible. Most importantly, all the speakers who have come and taken the valuable time and spent the time with us in enlightening us on the subjects, and also to the AV providers and photographers for this day, and of course our staff. The most important is you all. Without you, we can't do any program, and without your participation, nothing is possible. Thank you for your active participation. Thank you, and see you next.